You don't want to have a scenario where tech and tech capex slows down.
There could be just overall concerns about what happens if financial conditions stay too tight and what that means for AI and AI capex.
Tech contributes to the aura that surrounds the markets.
We need to see a development beyond AI and cyberspec. We're wary of being involved for too long.
Time for a breather. Everybody was piled into the same trade.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, chaos brews, heading into Jackson Hole. The pressure is building on Federal Reserve Governor Lisa Cook. As dated Fed minutes show officials more concerned about inflation, big tech is looking to find a firmer footing following back-to-back losses of more than 1%.
It's so much for this market to deal with. And kind of the ironic thing is we look back, for example, at this sell-off, and it's a perfect example of what happens when expensive markets wobble. After the fact, everyone looks for an explanation. Is it an MIT paper? Is it a week-old comment Sam Altman made? Is it Jackson Hole coming up? But that's the point. We look back and we only find stupid explanations because a lot of times expensive markets don't need a good explanation to sell off.
You might get another excuse tomorrow morning when we hear from Chairman Powell in Jackson Hole, Wyoming. Should we talk about those minutes? Dated, stale, dated. That's all I heard yesterday. But it showed me just how offside this committee was going into that payrolls report. Only two on that committee were really concerned about the labor market.
I think if at anything, it needs to take a 50 basis point cut off of the table. There were so many people in these minutes that were more worried about inflation and saw the labor supply story maybe as a benign one. So it implies that, okay, you have a crummy payrolls report, you can kind of massage the minutes. We know they can do that. They didn't do it to a large extent, so it just shows that maybe the balance of things might be more hawkish for Powell when we hear from him.
There is a big elephant in the room in Jackson Hole, and it's the independence of the central bank and the pressure coming from the White House. This from Governor Lisa Cook just yesterday. I have no intention of being bullied to step down from my position because of some questions raised in a tweet. I don't think we should underplay this. This is one of the most sensitive issues in politics in this country right now, the housing market, and the pressure will build and build on Governor Cook to provide a sufficient, appropriate explanation as to just what happened here.
Well, I think because a lot of people look at this and say, it's an expensive market, I'm having a hard time getting a mortgage, I'm having a hard time buying a house, and here's someone who maybe got around it. Look, Fed governors have left for less reasons. Remember what happened with Rosengren, for example, and the resignations there over issues with their compliance around trading. So it's not unusual to get this pressure. The concern, though, is this pressure is coming off the back already with pressure on Jay Powell and a president who's made clear he wants to remake the board.
Difficult to discuss a legal process that hasn't officially started yet.
That too.
Difficult for her to address a legal process that hasn't officially started yet. But I think for market participants, we need to gauge, are we seeing the credibility of this central bank be eroded over time? Are we seeing any sign of that in financial markets? When these headlines dropped yesterday, just a little bit of dollar weakness, just a little bit of strength coming into gold, but nothing big just yet.
Because I think the markets are interpreting this as great. More dovish Fed governors. It's more reason for the Fed to cut. The issue, though, is it's not just an attack on Powell anymore. When we were talking about, the conversation was the FOMC can handle it. It's a committee. Even if you have a chair who's very dovish and politically leaning, it doesn't matter because it's a committee that makes the decision. What happens when the committee is being reformed? What happens when you have a majority of appointees who are from Trump that also have the power to appoint presidents in regional governments? I think that makes a difference when it's not just Powell, but the board itself.
Abramo is missing today. She's over in Jackson Hole. We'll catch up with our very own Lisa in about 2 hours' time in Jackson Hole, Wyoming. Look ahead to this as well. Walmart earnings at 7 a.m. Eastern time. That's a big data point to look for. Another big data point at 8:30 Eastern time. We'll get jobless claims. And look out for this too. In the following hour after that, PMIs. Just an early snapshot of August. And the PMIs worldwide, at least the numbers I've seen so far this morning, picking up. Are we set to see a rebound for the month of August? Equity futures not bouncing. We're negative by 0.2% on the S&P. Your hour looks like this. John Stoltzfus of Oppenheimer will get into the stock market following 4 days without gains. Andrew Bishop of Signum, as Fed Governor Lisa Cook says she has no intention of stepping down. And Jane Foley of Rabobank seeing no real threat to the US dollar. We begin this hour with Stock Steady as the Fed's annual get-together in Jackson Hole kicks off. John Stoltzfus of Oppenheimer, the biggest bull on Wall Street, writing some profit taking without FOMO is to be expected. with Powell's address on Friday a catalyst capable of moving the direction of the market. John joins us now for more. John, good morning.
Good morning, John.
How are you explaining the last few days to clients?
Well, I would say very simply, it is to be expected that after a tremendous run-up from the lows on April 8th that were tested, and then all of a sudden we came back very powerfully over the course of, I guess, the last 3 weeks or so. You can't go up every day. And we've got a great catalyst for bears, skeptics, and nervous investors to take profits without FOMO right now, or fear of missing out. Myths, what's likely a secular bull market, because you have the Fed on Friday at Jackson Hole. Then beyond that, everybody's looking for the first week in September where you get the jobs number. What's the story going to be? Are we going to get another set of worrisome revisions? Is it going to be a big miss in terms versus expectations? And all that really in the process of some really heavy-duty transitions related to technology and innovation, related to AI, as well as an administration that really, for all the criticism it gets in some ways, is dealing with cans that have been kicked down the proverbial road for decades by both sides of the aisle. And so with that kind of uncertainty, what happens is you get some turbulence in the market. But we say, you don't want to buy the dips just blindly. You want to look for babies that get thrown out with the bathwater. For intermediate and long-term investors, very interesting time, I think, to see things like that. And for traders, in any turbulence, that's where they make their money.
So, John, let's unpack some of this. You make 2 big points, one on the Fed, the other on tech stocks. Let's deal with them individually. I want to start with the Federal Reserve.
Okay.
The minutes yesterday showed just how offside this committee was going into the payrolls report 2 days after the meeting. What we're all trying to gauge is just how much that payrolls report has changed things on this committee. If so, by how much? And how much will that change this address that we get from Chairman Powell tomorrow?
I don't think a heck of a lot, really, because the Fed is one thing it's shown since March of 2022, incredible sensitivity that is related to its dual mandate. So there'll be some kind of a balance here, because the dual mandate is relatively simple in concept, difficult to implement and practice, but essentially provide an interest rate regime that is conducive to sustainable growth without untoward levels of inflation, and on the other side of that, without overturning the apple cart for the jobs market. So I think, we still expect a 25 bips cut in September. We could even see a pair of cuts this year with something in December, another 25. I don't think they're going to cut a lot, but I think they make another down payment for both Wall Street and Main Street to show that indeed the Fed hike cycle is beginning to end, if not at the same pace everybody wants. And the independence of the Fed, John, I think is an imperative. I think Powell has done an excellent job. He missed it before March of 2022. Then he got on the case. They've raised rates 11 times, been on pause, I think, for something like 14 times or so in terms of the FOMC meetings, and no recession yet. Extraordinary, and now it's going to be, he's walking the tightrope, like Leon Russell might have said.
By the way, apparently there's a Wall Street Journal story that said Powell swims 3 times a week and has a personal trainer to try to relieve some of this stress. So I guess it's working to your point. But John, if we get a Powell who doesn't enforce a 25 basis point cut, if odds of a cut go to something like 50% from 80% right now. How bad is that for stocks? You'd get in short term. You're going to get volatility, but the trend is fairly clear of where we're headed. I mean, when you consider that what was it in 2021, we had 9.7% inflation. Versus 1.4% inflation based on what BLS was saying. It's remarkable. We're now around somewhere, but depending what gauge the Fed uses, somewhere around 2.8 to 3% inflation, whether you take CPI core, or you take it on the headline. Remarkably done, and he's a tough guy. He's an attorney. He's a former private equity guy. This is not a shrinking violet, and a good match for the administration. And the administration is used to high leverage. It's based on real estate and making the art of the deal.
And what we like to say is when we look at a 10-year Treasury around 4%, from a historical perspective, going all the way back probably to the Venetians, 4% for borrowing for a 10-year period makes a lot of sense.
I guess this is part of the thing of what we've been seeing the past couple of days, though. Some people have looked at tech selling off and gotten excited that it might mean finally a rotation is happening, that unloved parts of the market, to your point, the babies with the bathwater can finally be bought. But how necessary is it to get cuts in force, not just 25 and 25 and then pausing, but real cuts to bring us something to neutral or below neutral to see that broadening out?
Oh, I think we've already seen the broadening out, Danny. If you consider, I'm just looking at the SPXL1 on GRR on a Bloomberg. Communication services, that's about 80% tech because it's got the whatchamacallits, the search engines, and it's got the social media, and it's got the streamers in it. But then next, the second best performing is communication service, up 14.6% year to date. But the second best performer is industrials. That's a broadening, 14.5% year to date. It's just 9 bips short of where tech is. Third best performer year to date is utilities. The Utes up 13.3%. You're going to tell me that it hasn't broadened? The fourth best performing is infotech, up 12.5. Financials are up 9.17. That's a value sector. Materials are up 8. Consumer staples, that's Coke, smokes, and soaps, as we used to say in the old days, up 7.36. Real estate, all kinds of real estate, up 2.5. So, I mean, that's pretty humble. Healthcare is negative about a little bit less than 1/4 percentage point. Consumer discretionary, the consumer, remarkably resilient. The sector still being somewhat brutalized, down around 0.36%.
Sure.
And energy, you'd think we didn't use gasoline, but we are awash in oil, 0.4% down. So I think it has broadened.
To what extent is some of that just a derivative of the same story? You mentioned utilities, perhaps connected to the AI theme. Are we all in one theme, or are there several things playing out simultaneously?
It's both. It's several themes playing out simultaneously right now with a belief within the market from more than just a few corners that the Fed is in the process of lightening up on the tightening cycle. Utes are less exposed to being considered a bond market proxy, a bond proxy. So the yield will look more attractive as rates come down at the Fed. Even short end of the curve is their competition a lot of the time. Then for industrials, we're just about to build all these factories and all these fabs, smokeless fabs and stuff. With that, you're going to need a lot of industrial equipment. Whenever I travel anywhere in the United States, every road is clogged with construction vehicles, bulldozers, backhoes, all kinds of stuff. There's always agriculture, and commercial aerospace, defense. I mean, there's a lot of stuff happening, and financials should do better as the yield curve it steepens to a more traditional sense.
What's more traditional? What are you expecting?
Well, I mean, you'd probably expect it. Right now, I think we're pretty close to it with the 30-year almost at 5. It should probably be at 5. And the 4 probably vacillating depending upon the given month, somewhere between 3.5 and 4.8, just to put the scare into people.
What did the Medicis of Florence pay for 10-year money?
Pardon?
What did the Medicis of Florence pay for 10-year money? Since you mentioned the Venetians.
Obviously, I looked at the Venetians. It depends what we read. I'll have to think about the Venetians. You're going to send me back. I'll have to talk to Tom Keene about that.
TK probably knows.
He probably does.
Tom probably knows. John, it's good to see you.
Great seeing you,
Thanks for breaking things down. I appreciate it, sir. Thank you. John Stoltzfus there of Oppenheimer. Not too concerned about the drawdown we've seen over the past few days. One more big catalyst to go this morning, at least. Walmart. Those results about 45 minutes away. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira. Hey, Yahira.
Good morning, John. Federal Reserve Governor Lisa Cook says she will not be bullied from her position. Cook responded in a statement after calls for her resignation from President Donald Trump and allegations of mortgage fraud from housing regulator Bill Pulte. Cook added she'll answer any legitimate questions about her financial history. Meanwhile, inflation is still the greatest risk to the U.S. economy, according to most Fed officials. July's Fed minutes show members noted the risk to inflation outweighs concerns over the labor market. Several participants emphasized that inflation is still above 2% and it risks becoming unanchored due to tariffs. And Meta is temporarily pausing hiring in its artificial intelligence division while it structures its new superintelligence efforts. A Meta spokesperson saying on X that the company is pausing to, quote, plan and forecast after hiring new people. This was in response to initial reporting from the Wall Street Journal. That's your Bloomberg Brief. John?
Yahara, thank you. I think Mark Zuckerberg right now capable of moving the monthly jobs figure, wages alone.
I think he is capable of causing a recession in this economy if he decides to stop building.
More on Meta a little bit later this hour. Up next on the program, Governor Cook under fire.
I believe it's blatant and massive mortgage fraud. She shouldn't be at the Federal Reserve. She's going to resign, in my view. And if she doesn't resign, I do believe that the president has cause to fire her. And that will be up to the president whether he decides to do that or not.
That conversation up next with Andrew Bishop of Signum, live from New York City this morning. Good morning. Busy morning coming up. Busier than it has been, at least. Walmart numbers, the main event on the earnings side of things. That's taking place at 7 a.m. Eastern time. After that, look out for jobless claims, the last big print on the labour market going into Chairman Powell tomorrow in Jackson Hole. And a sneak peek of how we're performing for the month of August. Just an early read. Prelim. US PMI's 9:45 Eastern time. A few data points to watch throughout the morning. Under surveillance so far this morning, Governor Cook under fire.
I mean, this is supposed to be somebody who's entrusted with the public good, who's supposed to be looking after interest rates. And I believe it's blatant and massive mortgage fraud. I believe that there will be a criminal investigation. I'll leave that to the DOJ whether they do that or not. She shouldn't be at the Federal Reserve. She's going to resign, in my view. And if she doesn't resign, I do believe that the president has cause to fire her. And that will be up to the president whether he decides to do that or not.
So here's the latest this morning. Federal Reserve Governor Lisa Cook defying calls for her resignation, saying in a statement, quote, I have no intention of being bullied to step down from my position because of some questions raised in a tweet. Signum's Andrew Bishop joins us now for more. Andrew, welcome to the programme, sir. Let's just start with how difficult it might be to fire a Fed governor. How hard is that task?
Firing the governor is the easy part. Having the governor actually step down is going to be the harder part. I think any court that looks at this, first of all, is going to take a while to make a decision. And that's the biggest problem for investors, right? I would argue, this is debatable, but I would argue that the biggest problem is not if the governor actually is forced out. The biggest problem is the uncertainty. And that's inevitably going to linger. I also think it's unlikely that the court would actually force the governor out over the allegations that the president has raised, which kind of puts us in a worst case situation from a markets and uncertainty perspective. Interestingly, though, from the president's perspective, that's not necessarily that bad, because I think his main goal is to show that he's putting pressure on the Fed, more so than actually getting, an extra 25 basis points of cut in the short term.
So, Andrew, let's just build on that dimension of it, because I think we should just acknowledge this morning it's difficult to engage in a legal process that hasn't actually started yet. Andrew, with regards to the pressure on the Federal Reserve, could this influence Chairman Powell's tenure beyond May of next year?
I would say influence, yes, but most likely in the sense that it emboldens him to stay beyond May, right? And this is one of the ironies. I don't want to make any sort of unfair judgments on Chairman Powell, but I do think that there's a case to be made, or there's a hypothesis to be entertained that he started out apolitical and may be becoming more and more political because of President Trump's attacks, and sort of this idea that he feels as though he has to stand up for the institution, which, can turn into a bit of a vendetta going both ways.
Andrew, I thought Nick Timros at the Wall Street Journal put it really well, that the Fed is like the Vatican in that it has authority, but it has no army. What could be the army to help uplift the institution of the Fed? If you see more serious attacks start to crop up, is it Congress? Is it the markets? What could be an influence that acts as a ballast if this continues?
Yeah, I think the answer to that, and it's been the answer historically, is Congress. The problem is I don't think that army is going to be raised, right? In fact, there's a stronger case to be made that the opposite might happen, i.e., as of now, Polte and the president have tried to get the American public to sort of, be up in arms against the Fed, but it really hasn't gained much traction. I mean, as far as I'm aware, people aren't talking about how the Fed is biased against the American people in sort of, coffee table conversations. That could happen. the president, if he really puts all his energy into this, could start getting, Republican or at least MAGA voters really riled up against the Fed. So I see the risk there being more to the downside than to the upside of the cavalry is going to come rescue the Fed anytime soon.
Well, you have examples in history like Rob Kaplan, who resigned, saying that the focus on his financial disclosures became a distraction at that time when it was happening, Andrew. So there is precedent for Fed officials to resign because of this. If what you're describing happens and you get an American populace that starts to turn on the Fed, how does that change the cloud that's currently hanging over them?
So I think the big difference this time around compared to, and because there have even been cases of chairmen, if you go back much further in history, sort of right after Second World War, sort of resigning in the name of maintaining the Fed's independence or upholding its reputation, et cetera. The problem in this instance is that I think rightly or wrongly, whether it's Powell, whether it's any of the Fed governors that are coming under attack, they actually view resigning as further undermining the Fed's independence because it would essentially, open the way for Trump to bulldoze his way onto a majority and to eventually essentially a shadow chairman position. So while I recognize those historical precedents, I think that they're not comparable to what's likely to happen in coming months.
The issue around Fed officials back then, and Danny, I'm so pleased you brought this up. The issue around then was that a lot of people were really struggling in this country, and a handful of people were making serious money in the stock market. And that was a really sensitive issue at the time. And I think coming out of the pandemic now, what's interesting about this is about the housing market. And as we know here in this city, here in New York, that is one of the biggest political issues in this country of the very moment. And that's why I don't think this story is going away anytime soon.
And look, this story already existed in some form before this. The Federal Reserve of Philadelphia also did a study on this about how many people commit this type of fraud. And there were large numbers that did it. And there was an uproar at the time, localized, but an uproar at the time that people were doing this type of fraud because of what you're saying, that it's difficult to get housing in this country right now. So if it's happening with a high profile official, how do you quiet that down?
Andrew, can we just finish on that? The importance of the housing sector in this country for the future of politics in America?
I think it's absolutely critical, and it's one of the reasons why the president is putting so much pressure on the Fed. Frankly, there's this view I think that the president is sort of in an Erdoganomics mentality of not understanding how inflation works, et cetera. I think part of his attacks on the Fed is a genuine concern about the state of the U.S. economy at the real level, right? The real economy, the Main Street. We could debate all day long how genuine it is, et cetera. But the point is, I think he is actually worried about that. And that's one of the reasons he's putting pressure. It's not just about, touting that tariffs aren't inflationary or having a personal grudge against Powell. There is a real concern ahead of the midterms. And so I don't know if to his credit is the right expression, but he's ahead of the curve on this. Absolutely.
Andrew Bishop, appreciate your time, sir. Thank you. Andrew Bishop there of Signum on the latest push to fire Governor Cook at the Federal Reserve. Housing market's going to become so important. There is a belief that if you get rates down, you help real estate. The issue that we've got is which rate. We're talking about Fed funds. Does that actually help things further out along the curve?
Well, also, you just look at what's happened. We've priced in 100 basis points of cuts over the next 12 months. And the 10-year yield hasn't moved. So that in itself is just evidence that even if you do start to get cuts, especially if it's because of political pressure, it might not actually unlock this housing market.
10s this morning, yield higher by just 2 basis points. Your yield about 4.31. Coming up next, we'll catch up with Tom Forte of Maxim Group following a big tech sell-off. Plus, Yahara has your morning movers. Palantir looking to snap a 6-day losing streak. That stock up in a pre-market by 1%. Equity futures on the S&P 500 negative by 0.2%. Retailers in focus later on this morning. Numbers from Walmart about 35 minutes away. 4 days, no gains on the S&P 500 for the first time since the very start of August. Equity futures so far this morning, negative by 0.2%, the price action of the past 2 days at least. The weakness, the pain concentrated in a handful of tech names. The underperformance came from the Nasdaq this morning. We're down just another 0.1%. As we count you down to the opening bell, about 3 hours away from the cash open, let's get to your morning movers. Here's Yahara with more. Hey, Yahara.
Hi, John. We start with Palantir. It's a slight move to the upside, up 1%, but it is significant as Palantir tries to snap a 6-day losing streak that has pushed this high-flying stock into correction territory amid this broader tech sell-off that we've been seeing. And what also hurt Palantir yesterday was a Citron research report saying that the company was detached from fundamentals, and they say the stock should be priced at $40. We are obviously a long way from that, and Palantir remains the top performing stock in the S&P 500, which shares up 100% year to date. And sticking with tech, we have Hewlett-Packard Enterprises rising 3% on some sell-side action. Morgan Stanley turning more bullish on the server maker, and it's upgrading the stock to overweight ahead of its earnings, which are about 2 weeks from now on September 3rd. And it says its upcoming Analyst Day could lay out forecasts that finally convince Wall Street of its cash flow power. They're also setting a $28 price target on the stock, which represents about a 33% jump from these levels. And we end on Coty. The beauty giant is getting pummeled in the pre-market, down more than 20% after its results disappointed. This is the company behind CoverGirl Cosmetics, and they also license perfumes for the likes of Gucci and Burberry. And what they're saying is that sales could drop as much as 8% in the current quarter and keep sliding into December, as they warn that retailers are cutting prices to clear inventory, as they say consumers are pulling back on non-essential spending. So this could be a story of a cautious consumer or shoppers just not hot on what they're selling. John?
That stock is down almost 22%. Unreal. Yahara, thank you. Thanks for the update. More from Yahara in just a moment. On our radar this morning, one of our top stories worldwide, Federal Reserve Governor Lisa Cook pushing back against President Trump's call for her to resign over allegations of mortgage fraud. Cook saying in a statement, "I have no intention of being bullied to step down from my position."
This feels very different than the political pressure on the Fed chair itself, because a lot of the language and discussion around that had been, it's an FOMC that can handle it. This is a committee with multiple members. But what happens if you get real pressure, and we can certainly debate whether that pressure is warranted or not, on the individuals in the FOMC? It's kind of a whiff of an institutional overhaul, not just the head, but if you have more people appointed by the president who are willing to appoint presidents from the regional governors of the Fed that can more move in line with Trump, that's a very different makeup.
Super important to point out that no charges have actually been filed here. Totally unclear whether Attorney General Pam Bondi will even investigate. So this is playing out in the court of public opinion for the time being. And with that in mind, I just wonder if this is something Chairman Powell needs to address head on tomorrow morning in Jackson Hole.
I doubt he would, right? He wants to avoid the politics to all degrees. I think maybe what will happen is you get all the central bank heads coming from Europe, from elsewhere, that really come to make a statement about independence, that lend Powell their support. And we know Powell likes that support. He apparently keeps letters of those who have thanked him for his steadfastness. So I think it's going to kind of be the unofficial theme of Jackson Hole. It has to be. But you'd imagine that this is the Powell who does not want to get into politics at all.
Lisa Abramowicz on the ground. We'll head over to Lisa a little bit later this morning to pick up on this story. Elsewhere, new details in the efforts to end the war between Russia and Ukraine. The Vice President J.D. Vance saying Russia wants Ukrainian territory, which Ukraine still controls. Talks are still underway to set up a potential meeting between the two countries.
There's also been a conversation about what role, if at all, Russia would play in broader security guarantees for Ukraine. Russia's made it clear that if there are security guarantees, it and its ally China need a say. And I think that underscores that Russia sees this not just as Russia versus Ukraine. This is Russia and the West. If we are talking about security architecture, they want to have a say. For Ukraine, I don't know how this is palatable. Those places to the east of Ukraine are so necessary for their defense. If they give it away to Russia, what the cities that come next are much harder to defend.
I'm pleased you've said this. We had some momentum coming out of the weekend. It looks like that momentum has kind of been lost over the past few days. The president wanted to see a bilateral setup between Putin and Zelensky. Little appetite for that to happen out of Russia so far. That might change, but so far, not much appetite. The president also envisioned this ending in a trilateral between himself, Putin and Zelensky. And to your point, The big wrinkle there is the Russians would like some Chinese involvement. And I'm not sure either the Europeans or the US or the White House saw that one coming.
They don't, because what he would have wanted is a trilateral of the US in between Russia and Ukraine negotiating. All of a sudden, you enter China into that. And you need them part of the negotiations as well, which, by the way, the U.S. and China are having their own negotiations separately about trade. It really complicates things. And I think for all parties involved, the bar to a deal is incredibly high.
It was always going to be hard, and it's proving to be even more difficult. More on that story later on this morning here on Bloomberg. Wanted to finish on Meta. The latest from them, freezing hiring in its artificial intelligence division. A Meta spokesperson saying the company will be planning and forecasting its new super intelligence efforts. The length of the pause is unknown.
Honestly, I saw this and I thought, who do they even have left to hire? They've hired everyone. Maybe the freeze is happening because there's no one left. But they've hoovered up basically all of the AI talent. They've given them sports-like salaries to get them to go there. Is this a hollowing out, I wonder, of VC, of other smaller companies? We've seen them do this time and time again. They've stopped acquiring companies to grow AI. They've just left the companies alone, but hired all of their top talent. You saw this with Google. You saw this with Meta, rather. So what does it mean for the future of AI innovation? And I wonder just the level of hiring that they've done, if it in a way kind of stifles AI innovation because you don't get these smaller startups that can thrive anymore. If you're an investor, why would you invest in a small AI company if Meta just might hire the talent away?
And that's what they've been doing over the past few months. They've pursued this so aggressively in a way that they're almost confronting existential risk. And I keep reflecting on a quote that came from Alphabet 12 months ago when the CEO came out. The greater risk now, he said, the greater risk now was underinvesting and not overinvesting. Now, this is why we're having this conversation ultimately about ending up with too much capacity, overcapacity, and some major losers. And every time you get a pullback like we have done in the market over the past few days, people start to get nervous.
I gotta say, it feels a little bit more scary than the dot-com bubble, because back then when the bubble burst, it was equities that were hit, and yes, businesses did suffer. This time we're talking about a completely different beast. We're talking about infrastructure. We're talking about energy, data centers, hiring, so many parts of this economy that have been impacted by AI. If they decide to pull back, what happens? What happens when you've had, by some calculations, a 10% increase in GDP because of AI? If we lose that, does that amplify some recession risk?
Yeah, this is not just a tech story. It's the US economic story at the moment. Let's stick with tech. The Nasdaq 100 looking to recover following back-to-back losses. Tom Forte of Maxim Group writing this: I understand the investor concerns about an AI bubble, given the high valuations, and in many instances, it remains unclear to what extent AI will enable companies to generate higher sales and earnings over time. Tom joins us now for more. Tom, welcome to the program, sir. I'll just start with a basic question. How you're explaining the moves of the past few days?
Yeah, so I definitely think what you're seeing is a AI concern pullback in big tech, either to the extent that Sam Altman's talking about a bubble when it pertains to AI, or when you're reading stories about what is the ultimate efficacy of AI in helping enterprises improve their sales and profits.
Tom, how are we defining a bubble? Howard Marks of Oak Tree Capital came on the program yesterday and said maybe this is more like 1997 than 1999. If it's 97, I'm buying. Tom, what are you
telling
people?
Having lived through .com.bomb, I would define a bubble as, are the valuations not reflective of the future earnings power? So are you valuing a company at 100 times earnings when in the future they're going to generate 5% EPS growth rather than 10 or 20%? So I just think of it as, are the expectations too high given future cash flows?
Well, this is the thing, Tom. If we just pick apart Sam Altman's comments, I mean, this is the CEO of a company that raised $6 billion of equity at a $500 billion valuation. It's almost as if he's suggesting there's a bubble everywhere but his own company. So if there are concerns of froth in the market, Tom, where would they actually be?
Yeah, so I think that, when you think about to date, where have we seen AI prove its efficacy, or where has AI driven incremental sales and profits? It kind of starts with NVIDIA. And then after NVIDIA, you have Microsoft, Amazon, Google, the hyperscalers, because you have seen severe increase in interest in AI that's driven sales for NVIDIA, and then also driven the enterprise sales through the cloud computing efforts of Microsoft, Amazon, and Google. And then I guess for everyone else, it's to varying degrees. Although I think you could argue that Meta Platforms has seen some improvement in its digital advertising revenue because of artificial intelligence.
Tom, it really wasn't that long ago that you had Zuckerberg talking about the year of efficiency, and part of that was a pullback in share prices that had them cap how much they really wanted to spend. It's a completely different story today. But if you did see this type of sell-off pick up in some steam, do you think Meta, the other hyperscalers, that they would pull back some of their spending efforts when it comes to AI, and what ramifications could that have?
Yeah, so I think about, in that regard, DeepSeek. So you had DeepSeek proving that either through software, you can do it as well as others have, or you can just do it more cheaply. And then you saw the hyperscalers, you saw Meta platforms essentially double down, saying that they were going to maintain this elevated level of investment spending as it pertains to artificial intelligence. So I think that you would have to start to see enterprises pull back on their spend, which would be reflected in lower cloud computing revenue for Microsoft, for Amazon, for Google. I think that would be direct evidence that you started to see, I guess, a pullback in AI spending for enterprises who maybe haven't seen the same benefits that others have.
Tom, can we ask you, does it get harder to pick winners when the White House wants to get in the business as well?
No. I think the reason I say no is because I think with the White House, what is the ultimate goal of the move that the White House is making? So going back to Liberation Day, the view that I had was that this was the beginning of trade negotiations at scale. This wasn't necessarily going to result in some of these tariffs on a long-term basis. So then what is going on? You've talked a lot about the Fed and maybe changes to the board of the Fed and lowering rates. So what is the ultimate goal of the White House? Which I think, what's the ultimate goal of any business? And then how to assess how that results in higher sales or lower sales and cash flow and stock prices.
Well, Tom, let's get into that. So basically, I think the assumption at the moment is the free hand to the market is not going to generate or lead to the outcomes they'd like to see. Primarily, building out domestic foundry capacity. So what do? You take an equity stake in a company like Intel and you support that effort domestically. You get involved, government intervention. All makes sense, particularly when you're very worried about national security. The next step in a lot of people's minds is basically to go to fabulous companies like NVIDIA and push them to use that domestic capacity over using capacity somewhere else, say at TSMC. Now, Tom, that gets difficult for the likes of NVIDIA. And once everyone gets their fingers in the pie, if I'm China, I'm like, by the way, I don't want you selling here anymore. Aren't they some of the risks that we have to confront over the next few years?
Absolutely. And I like what, Jonathan, you said there is about national security. So I think a lot of the tariff-related moves by the White House or by the administration are try to address national security. It's part of the AI war, if you want to call it that, between the U.S. and China. And I think that really is a big motivator between having or to have more manufacturing U.S.-based.
Tom, appreciate your time, as always, sir. Tom Forte there of Maxim Group, breaking down the moment for big tech. And it's a big moment for big tech, particularly with the government getting involved and saying, you know what, we think we can pick the winners too. It's
also so complicated if you're in NVIDIA because you're getting hit by both sides. There was a story from the FT out this morning that some of the China leadership told these tech companies to stop using NVIDIA because of insulting comments from Howard Lutnick, that he said he wanted the Chinese to be hooked on American technology. What do you do if you're NVIDIA? I mean, Jensen Huang, notably, during the inauguration, wasn't in D.C., he was in China with Xi Jinping. So that man understands more than anyone, I think, that it is two sides that he is stuck in between.
It's going to get harder and harder to remain and succeed in both markets, and we'll see that play out through this year and beyond. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Back with us, here's Yahira. Hey, Yahira.
Hi, John. The Texas House of Representatives approved a new state congressional map, officially ending the weeks-long political standoff. The proposal passed easily in the Republican-dominated House, where the vote was delayed after Democrats left the state to deny quorum there. Texas Democrats vow to battle the new map once Governor Abbott signs it into law. Meanwhile, Tom mentioned this one. Chinese AI startup DeepSeek is rolling out an update to its model. The V3.1 answers questions much faster and marks the company's first step towards creating an AI agent. DeepSeek is also raising prices for its update and abolishing discounted evening rates. The changes take effect on September 6th. And WH Smith shares are plunging 40% in London, the British retailer lowering its profit outlook for the fiscal year after finding an accounting error. It found an overstatement of about $40 million in expected trading profit for North America this year up until August 31st. The revision cuts its North American profit forecast in half. That's your Bloomberg Brief. John?
Cutting the stock in half as well. Yahara, thanks for that. More from Yahara in the next hour. Up next on the program, U.S. exceptionalism.
The U.S. is still the best place in the world to invest. The things that make the U.S. exceptional are still all true. Other parts of the world do not have our dynamism.
That conversation up next with Jane Foley of Rabobank, live from New York City. This is Bloomberg. Live from New York City this morning. Good morning to you all. Welcome to the program. Your day ahead is shaping up as follows. A little bit later this morning, so about 12 minutes away, we'll get another read on retailers in America. Walmart coming up very shortly. 8:30 Eastern Time. U.S. jobless claims in focus. Another read on the labor market. In fact, the last big read on the labor market going into Chairman Powell's speech in Jackson Hole, Wyoming tomorrow for their annual get-together. And a snapshot of some of the economic activity as we make our way through August. Look out for the PMIs. Those PMIs drop at 9:45 Eastern Time. But as we await those numbers from Walmart, I think it's worth taking stock of what we've heard from consumers over the last 3 days or so. Home Depot. Essentially the message, Danny, from Home Depot. Customers are delaying purchases. TJX, off-price retailer, get in the business. What have you seen? You've been talking about it. Sweet Green, soft demand. Carver, soft demand. Just getting a mix. I think a decent picture of where the consumer's at as we work our way through summer. We might re-accelerate in the months to come, but there's certainly been a deceleration through the first half of the year.
There's been a deceleration, but the difficult thing about this is you can find examples where companies are thriving. Everyone's still buying Birkenstocks. People still want to travel. So you get these commentaries from companies that do seem to suggest that consumers are doing okay. And I think Walmart is going to be really instructive here just because they do have more pricing power than a lot of these other companies. So it shows without tariff price increases just how robust is the consumer. And by the way, they now capture a much wider swath of the consumer because people post-pandemic traded down to Walmart. So you can't look at them and say, oh, this is just a read on the K-shaped economy, how lower income consumers are doing. Wealthier consumers have turned to Walmart now, too. So I think it also captures just a broad group of the populace now.
When you hear from these companies, don't just listen to what they say, watch what they do. Really start to gauge what the C-suite strategy at the moment is. So let's take two companies. I believe that if companies can raise prices, they will. If companies can get away with lousy pay hikes, they'll get away with it. What have we seen? McDonald's dropping prices. Starbucks, below inflation pay hikes. I think there's some signal there from those two companies alone.
Yeah, a 2% pay hike, I think you'd be a little bit disappointed from that. Pay attention to what they say, but how much can they say, especially for Walmart? Remember, it was Walmart in May that said we might down the line have to raise our prices because of tariffs. And immediately you heard from the president saying that you need to be eating these prices. So just how vocal they can be on these earnings calls about how they're trying to mitigate tariffs, it might be capped because they know that the audience isn't just analysts, it's not just investors, it's the White House.
It's the White House in a big way, that's for sure. Equity futures right now in the S&P 500 negative by 0.2%. Under surveillance this morning, U.S. exceptionalism.
The U.S. is still the best place in the world to invest. The things that make the U.S. exceptional, the spirit of innovation, the free markets, the rule of law, the capital markets, the growth and dynamism, the great companies. These things are still all true. Other parts of the world do not have our dynamism.
Here's the latest this morning. The dollar in focus ahead of Fed Chair Jay Powell's comments from Jackson Hole tomorrow. Jane Foley of Rabobank writing the following. Although the Chinese authorities and potentially the Europeans have an incentive to try and improve the standing of their respective currencies in FX reserves, they pose no real threat to the US dollar. Jane joins us now for more. Jane, welcome to the program. Institutional credibility is also in focus in Jackson Hole tomorrow. How's the rest of the world responding to the developments that are taking place here in the United States?
Well, I think we hear that, and we will hear that in Jackson Hole from the comments of some of those other central bankers. We have heard in the past couple of months. Really comments from the likes of Christine Lagarde at the ECB and Bailey, both giving their support for Powell, giving their support in terms of his character. But I think more broadly, probably we can read between the lines, and they are giving their support for an independent central bank too, because that is what has become normal. That is what is considered to be important in most modern economic literature in terms of gauging or really anchoring inflation expectations going forward, which is a big part of how consumers and businesses behave. So I think it is likely that we'll hear more support from Powell. But of course, like you've just been talking about, the shadow of politics will loom large over the Jackson Hole events, and it's going to be very interesting how the US Federal Reserve bankers really play this in the next few days.
Jane, how vocal do you expect them to be about this? How much do you expect to hear from Jay Powell about issues of independence at the central bank?
I think probably a lot of the references will be subtle, and that we'll be inferring various different commentary. I don't know if he is going to be, that forward in making a big confrontation with respect to, this political risk that is potentially out there. And after all, we've got to make the case that there are a lot of economists, who agree with Donald Trump, who see that there is the likelihood of the US labor market weakening, and therefore demand weakening, and therefore inflation weakening. A lot of economists are of the view that inflation that could come from tariffs could be transitory. So, from that point of view, that you could say, well, look, there is a decent economic argument. This isn't really about political interference at all. So, there is that point of view to be considered. And from that point, I think Powell will be cautious.
Jane, just before you go, there's an odd dynamic here emerging whereby the overwhelming consensus is that the Federal Reserve cuts rates in September, yet the overwhelming consensus for tomorrow is exactly what you just said. He's going to be cautious and he won't lock it in. So often when we go into events like this, I think, where is the greater scope for disappointment? Jane, can you explain that to me, given what I just said?
Well, I think we've already seen the dollar just come back a little bit stronger this week. And I think that's the market thinking, we do expect an interest rate cut. But Trump has been cautious all the way along. We had that PPI data last week. What if he remains cautious? The minutes of the FOMC show the majority are still concerned about inflation, which perhaps we already knew because, we knew that we knew what the voting pattern was at the last FOMC. But again, that brings home the fact that there are perceived inflation risks out there, that Powell has played a cautious hand, that many of his supporters within the Fed, also have a similar view. So it is going to be interesting to see if there's a change. I think this week the market is wary that there could be that Powell could stick to his guns, and therefore the dollar has strengthened. But at the same time, the labour market is weakening. So, we all need to see what the next round of economic data is.
Jane Foley of Rabobank. Jane, thank you. If you go back to that Federal Reserve meeting, the labour market's solid. Heard it on repeat in the news conference from the Fed chair. The minutes themselves look super offside relative to what we heard 2 days later when we saw the payrolls report. The assumption is now that these views will change. Now you've got the payrolls report in hand. I just wonder if that's where there is scope for disappointment. Imagine if the views remain the same, even after that.
Right. What happens when you're pricing 80% odds of a Fed cut? What happens to markets if that goes to 50?
It would be kind of shocking. Let's put it that way. Futures right now in the S&P 500, negative by about 0.1%. Up next, we'll catch up with Alessio de Longis of Invesco, Ed Mills of Raymond James, and the former Fed Governor, Betsy from New York City. The second hour of Bloomberg Surveillance. Up next.
The Federal Reserve is going to work on normalizing the yield curve.
We think the Fed's going to deliver the rate cut in September.
So much is going to really depend on what the Fed chooses to do at the next meeting. A 25 basis point cut seems absolutely set it.
Even if they cut in September, it's then not going to necessarily be a slam dunk that there'll be a December cut.
I'm concerned that we have 4 rate cuts baked in for the next year, and long-term interest rates really haven't come down much at all.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now, live from New York City this morning. Good morning to you all. As we count you down to the opening bell, 2 hours and 30 minutes away. Your scores are shaping up as follows. On the S&P 500, negative by 1/10%. On the NASDAQ 100, just about unchanged. As we approach a big morning, looking for Walmart earnings, those numbers just crossing. Then later, 8:30 Eastern time, we'll get numbers for jobless claims. And later on this morning after that, you'll get a read on US PMIs in America at 9:45 Eastern time. For Walmart, the stock is down by 1.5%. Danny, what have we got?
Well, it's something you usually don't see. It's a miss and a raise. So for the current quarter, they missed, but their outlook, that is something that they were able to lift. And I think this is going to be really important. The CFO talking to Bloomberg saying that the consumer is resilient. And it's not just the upper income levels that are doing well. They're gaining market share across the consumer levels. And it seems that for that reason, they were able to upgrade their guidance. The question, though, is how much of that is just Walmart and their ability to control supply chains versus a more wider, resilient consumer?
We keep going back on this. This is not a one-off event. It's a process. And how things are now, they might be different in several months' time. Take this quote. You mentioned the CFO. We're trying to do our best to minimize the impact on the consumer from higher tariff costs. Trying to do our best. That might not be the case in a few months' time. If they can pass this on, if they can maintain and improve market share and pass this on, they will. If they can't right now, that's a signal investors will take about a consumer that maybe can't take it on at the moment.
And maybe that's why you have a Walmart who maybe can be a little bit more squishy with the margins. But again, they have this pricing power. They have the supply chain where they can do this. So Walmart maybe isn't as instructive as small businesses who don't have that, who need to raise prices, and then they lose market share to Walmart. So Walmart does become a bigger behemoth in this if they are willing to do that land grab. But I think you're right, John. How much longer are they willing to do that land grab if it does do something to their margins?
You can always cherry pick things in earnings season, and forgive me for cherry picking this, more discounts. Yes, you're likely to see more discounts at Walmart. By their very nature, that's what you go to Walmart for. But this is what we're hearing elsewhere. McDonald's putting pressure on franchise owners to drop prices because they know the consumer just can't take it right now. Look, these aren't things that happen when the backdrop for the economy is screamingly solid. And that's clearly not the case at the moment.
And I think that's why people look at TJX earnings and say this is an entire company that's geared up to sell discounts and they're doing well. So great for them, but potentially bad for everybody else. The important thing, though, is that people are still spending, even though there are discounts. But how much does it start to look like a Target where if you have discretionary items, people aren't buying that, and you go more to the Walmarts to get those goods that you need that are staples?
Danny said it, it's a miss and a little bit of a raise. The stock is down by about 0.75% at the pre-market. More on Walmart this hour. Plus, coming up, we'll catch up with Alessio de Longis of Invesco as stocks look to snap a 4-day losing streak. Ed Mills of Raymond James as the pressure on the Federal Reserve continues to build. And the Kansas City Fed President Jeffrey Schmid sitting down with Mike McKee in Jackson Hole. We begin this hour with stocks lower following a stream of earnings from U.S. retailers. Alessio de Longis of Invesco writing the following. Private sector demand and labour markets are softening, and credit card delinquencies point to challenges ahead for consumer spending. Alessio joins us now for more. Alessio, good morning.
Good morning.
Do you see this as temporary? Do you see a reason for there to be a re-acceleration in the months ahead?
We see this as the beginning of a process that has been very, very slow and continues in the months ahead. The softening of the labor market, the softening of the economy. You mentioned the credit card delinquencies. The Walmart report today is another testament of how Walmart is representative of the economy, but not the market, right? Walmart gaining market share is a defensive sign. You are absolutely right. We haven't seen yet the impact of tariffs. We had an April announcement. We had a 90 days delay. The real impact will be shown with the holiday season, right? Takes a while for prices to adjust. We are seeing some price impact reflected in the PPI numbers. But ultimately, we had in the first 6 months of the year, we had a massive inventory build as companies front-loaded imports in the anticipation of tariffs. Those contracts, those prices were already set. Holiday season is really where we're going to see the full impact. We think the consumer will start giving in more and more punches. The question remains, why are all the cyclicals not leading to that typical transmission mechanism into the broader market?
Because they want to trade the next phase of this. They think the Federal Reserve is about to cut interest rates and it will see a re-acceleration through 26. People gave up on 25 a number of months ago. As you know, the question I think people have now is whether that's the right move or not. And I always ask this question, can you trade to the recovery to the downturn we haven't had yet?
I think that's really where that trade-off is and what is making it particularly challenging for investors such as ourselves. We are positioned defensively, and the answer to that question we find to be in that sound risk budgeting, right? We believe it is the case to be overweight fixed income relative to equities, but then again, when you are underweight equities, what is the best way to cushion your risk of being wrong? Be overweight quality, underweight cyclicals. Right? If you're right on your cyclical picture, maybe more than being underweight equities are right, most of that underweight to be expressed through the cyclicals, through value, through small caps and mid caps that are actually more exposed to that economic risk. Look at earnings season so far. We have 87% of companies having reported. What do we see? S&P 500 earnings up 10, 11%, but cyclicals flat to down 4, 5%. Other defensive sectors also somewhat flat. Tech up 25% earnings. So you continue to see this the part of the market that is representative of the economy and the cycle, and the part of the market that continues to reflect a structural trade. It's two different things.
One of the things that's really hurt defensives is one of the sectors that you would typically buy, which is healthcare. If you look at all the sectors and what they've done so far this year, healthcare continues to languish, and that's because of the politics in D.C. and the fear of sectoral tariffs. How much does that change where an investor goes for safety if politics starts to cloud the very classic textbook defensives?
It is a challenge. It is a challenge because, especially from our perspective as more macro-oriented, cycle-oriented asset allocators rather than fundamental analysts of individual sectors, that provides a challenge. These are the unintended risk exposures that, from our perspective, you can really solve by diversification and risk management, rather than trying to re-engineer your investment process under the adage, this time is different, let me scrap the old playbook. Adhere to your investment process and recognize these challenges from a regulatory perspective. So we like to express those defensive views through low volatility stocks and other defensive sectors, overweighting those and not concentrating all of our defensive bets into one particular sector.
I say some of those low volatility stocks have done really well in recent days as you've seen momentum sell off. To you, when you look at that, how do you gauge whether it's a temporary blip or actual rotation happening in the market?
So far, we've had many blips and not a real rotation, and it has been the frustrating piece of this. Why? Because this cycle, the real defensive play has been manifested itself into the quality high volatility stocks, not quality low volatility stocks, namely the Max 7. That's been the issue. So your typical defensive trade is a combination of quality and low vol, but right now you're not seeing that combination play out. We therefore continue to underweight small and mid as a cautious way of finding confidence in that equity underweight while letting the large cap portion of the market still be the representative of our total equity exposure.
Can you just build on your regional bias?
Yes.
What is it at the moment?
We are still moderately overweight U.S. equities relative to international equities, both developed and emerging markets. Earlier in the year, for the first time in a long time, we took a pause and reset to a neutral equity regional exposure for the first 4 or 5 months of the year. That was mostly driven by the dollar sell-off, which explained more than half of the outperformance of international stocks. We are not seeing that validation from the earnings picture. So when you look at relative earnings momentum between international and U.S. equities, still favoring U.S. equities. The dollar story is still one of dollar depreciation. We spoke about this in prior segments.
Yep.
We think the Euro 130 is not an aggressive call. Euro 130 within a couple of years, it's probably going to be the normal equilibrium in FX markets. So is U.S. exceptionalism is still there. The economic story is undoubtedly still there. The pricing of it and the cyclical dynamics, I think we're going to be for a much more balanced global equity picture.
So 130 for people in their 20s on trading floors right now sounds obscene. at 116.55 right now. Anyone who started their career after, say, 2014, when Draghi took interest rates negative, won't really understand that maybe the euro can live at these kind of levels. 130 will sound absolutely bonkers to a lot of people. So can you explain why we can live at 130 on euro dollar?
So we're dating ourselves, basically.
A little bit, maybe.
And 130 sounds obscene, but you and I remember during the European debt crisis how the euro remained stably around 140, 150. How can we get there? The first catalyst is yield differentials. We are in an environment where most foreign central banks, including the ECB, don't have much more room to cut rates. The Fed, we are going to go there slowly, but they can easily lower rates by 150 basis points, taking effectively yield differentials to almost flat. That is going to be a big shift in terms of currency hedging flows in favor of the euro away from the dollar. Valuations from a purchasing power parity perspective, wage adjustments, productivity, it's still arguing for a euro being around 125. And then let's not forget the gap in the funding needs, the large current account surpluses, the large and growing current account deficits between the two regions. The biggest driver in our mind, the biggest adjustment mechanism for the current stress around U.S. funding levels is not, in our mind, U.S. Treasury yields, is the dollar. The dollar is the first and easiest path of least resistance for the adjustment of the external funding needs that the U.S. will have on a go-forward basis relative to the rest of the world. So those are the dynamics: fiscal, valuations, and yield differentials.
Alessio, smart, as always. It's good to see you. Thanks for dropping by. Thank you. Got to do it again soon. Alessio, the longest there of Invesco. Let's get you an update on stories elsewhere this morning, including the latest on Walmart with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. Exactly. We start on Walmart. Shares are dropping 2.5% this morning after a rare miss on earnings, but a raise on its full-year guidance. Stores open at least 1 year, saw sales higher than expectations. Adjusted earnings, though, came in lower after higher insurance claims. Walmart's CFO saying they expect continued market share gains across all income levels. Meanwhile, this story dropping just in the last 10 minutes, and Boeing shares are higher as a result, up 1.7%. The plane maker is reportedly finalizing a deal to sell as many as 500 aircraft to China. Sources telling us here at Bloomberg that the sale would depend on lowering trade tensions between the U.S. and China, and that talks could still fall apart. Chinese officials have begun asking airlines about how many Boeing planes they would need. And Google is leaning into its Gemini AI assistant. The tech giant unveiled new AI-powered gadgets yesterday. The new devices include the Pixel 10 Pro Fold, the Pixel Watch 4, and Pixel Buds 2a. The models will cost between $130 to $1,800 and will be in store this month. Google's launch comes before Apple is expected to show off its new iPhone in September. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, pressure building on Governor Cook.
I believe it's blatant and massive mortgage fraud. She shouldn't be at the Federal Reserve. She's going to resign, in my view. And if she doesn't resign, I do believe that the president has cause to fire her. And that will be up to the president whether he decides to do that or not.
That conversation up next with Ed Mills of Raymond James, live from New York City this morning. Good morning. News on Dayforce just breaking. These headlines across the terminal. Thoma Bravo to take Dayforce private for $70 a share in cash. Stock trading at $68.35, up 1.4% this morning.
There's been just a huge spate of take privates. It's Dayforce today. Yesterday it was Guess. Earlier it was Soho House. You're seeing a lot of these companies not wanting to find homes in the public markets, and privates are happy to jump in. I'm really excited that I'm going to be speaking to Thoma Bravo partner Holden Spate about this, and I wonder just how easy it was for them to convince Dayforce that they should be a private company.
This is a theme I'm pleased you picked up on the other companies. This is something Mark Rowan of Apollo's talked about repeatedly. the private market's going to get bigger and bigger, and maybe the activity in the equity market, the public equity market, gets smaller and smaller?
I think it's something like since the 80s, the amount of public companies have shrunk by half, to the point where I was even talking with one private equity executive who said that other smaller markets like the UK, that there's maybe no even real reason for public markets there to exist because no one wants to exist on those exchanges.
Danny's sitting down with Tom Bravo later on this morning. Look out for that conversation. 11 a.m.?
11 a.m.
11 a.m. Eastern Time, right here on Bloomberg TV. Dayforce positive by 1.3%. Under surveillance this morning, pressure building on Governor Cook.
I mean, this is supposed to be somebody who's entrusted with the public good, who's supposed to be looking after interest rates. And I believe it's blatant and massive mortgage fraud. I believe that there will be a criminal investigation. I'll leave that to the DOJ, whether they do that or not. She shouldn't be at the Federal Reserve. She's going to resign, in my view. And if she doesn't resign, I do believe that the president has cause to fire her. And that will be up to the president whether he decides to do that or not.
So here's the latest this morning. Fed Governor Lisa Cook saying she will not be bullied into stepping down. President Donald Trump calling on Cook to resign over allegations of mortgage fraud. Bloomberg's Mario Parker joins us now from Washington for more. Mario, welcome to the program, sir, and good morning. Do we know if the Attorney General Pam Bondi is going to pursue this?
We don't know yet. That's the one uncertainty so far. We know that Bill Pulte is pushing for it right now. We know that this is something that he tried also with Jerome Powell a few months back as well, as they tried to exert power there. Whether or not Pam Bondi will follow through with an actual investigation or indictment along those lines remains to be seen at this point.
Mario, do we know where this came from? Was this an individual investigation? Was this something that Mr. Pulte was looking across the whole of the Federal Reserve System, select individuals, across the whole government? What was the approach taken here?
Well, there's a couple of things that we're seeing emerge right now. We're not sure. One of the questions that we are trying to figure out is some of the mechanisms, how Lisa Cook's information got pulled and why, right? But what we do know is that Bill Pulte essentially has emerged as a somewhat of a flamethrower for the president, right? So he's waged this campaign that we've seen against Jerome Powell, for example, for a couple of months. He's worked with Luna in the Republican representative from Florida, for example, to try to bring something there as well in terms of investigations. We've seen him just try to stir the pot here with Donald Trump's either political enemies or, in the case of Lisa Cook, someone who is standing in the way of some of the some of the programs that he'd like to enact.
Mario, appreciate your time. I imagine you'll keep tracking this story. Mario Parker over in Washington, D.C. Ed Mills of Raymond James joins us now for more. Ed, help us continue this conversation. We've seen plenty of pressure put on Federal Reserve officials for years, for decades. Is this different?
Yeah, it's really different. I don't think I've ever seen a government official come out with mortgage documents accusing them of fraud, getting a potential criminal referral over to the Department of Justice. What we have seen here is that the Supreme Court, in an opinion by Justice Roberts, saying that the only way in which the president could remove a governor or the Fed chair is for cause. And Bill Pulte is trying to find cause. He went after Jay Powell on the renovations, and he's now going after Governor Cook on her mortgage documents. Whether or not it works, that's a big if. I do think that there's a higher probability that President Trump would be willing to fire a governor versus the chair because the chair has a high profile. Most people in Washington and in this country don't know who the Fed governors are, which puts this at a much higher risk.
Presumably, Ed, though, if the president does try to do that, a legal battle would unfold. Just how messy and complicated would that get for the Fed and investors trying to understand the future of the FOMC?
Yeah, Danny, I think it's a really interesting question because on one hand, Dr. Lisa Cook has the longest part of her term left. A term on the Federal Reserve is for 14 years. She goes into 2038. So she certainly could play this out for years if she wants to. However, when I've observed the Fed, I do believe that they have some level of independence, but they keep that level of independence by navigating the political waters in Washington, D.C. They look to see their actions and say, is this going to cost us our independence? Is this going to cause change? What can we do to make sure that the rest of D.C. largely leaves us alone? So I don't know if this is a Fed that necessarily wants to go through this battle, but it's also a Fed that does not want to be seen to be caving to the political pressures. So, Danny, what I look at is, are there other officials at the Fed that might be thinking about leaving that stay on longer, especially Jerome Powell, because traditionally the chair leaves, but he is not required to leave once his chairmanship is up because his term as governor goes into 2028.
So in this future where perhaps they are able to get Cook out, and to your point, she has a long term ahead of them, a lot of noise has been made that you maybe would have 4 Trump appointees of Fed governors and that they could reshape the FOMC. Ed, you have people like Waller on there who are very well spoken in their dovish view and don't necessarily seem to be caving in to politics. If you have Myron, if you have Bowman, you have one other. Does that change? Does our trust in the political independence of the Fed alter?
Yeah, Danny, this is a big question I've been getting at Raymond James. They want to know, is the independence of the Fed up for debate? They want to know what the direction of monetary policy and regulatory policy is going to be. It's very clear that the regulatory policy is picking up steam. Michelle Bowman, the new vice chair for supervision, she's aggressively pursuing that. So we know that's locked in. But the Fed is a consensus building body. Most votes are 7-0. Most votes are unanimous on the FOMC. In the last 20 years, we had 2 no votes on a monetary policy decision, 2005 and then Michelle Bowman in the fall. Last meeting, we had another 2 votes. And so what we're looking at is, as there is a shift in the majority, because right now there are 2 Trump appointees, Waller and Bowman, but once Powell is out, once Mirren is in there, that's where you know that it's 4-3. It might be 5-2 if Michelle, if Dr. Lisa Cook decides to go, or if Michael Barr decides to go, Phil Jefferson decides to go. And at that point, does the rest of the team decide to largely go along with these policies, especially on monetary policy, because the Fed always wants to send the message that this is not partisan, that they have looked at the data. This is what the model says. They have the best economists in the world. And Danny, they want to say that this is the right decision, that there wasn't a lot of debate on whether or not this should happen. And if they don't have the ability to do that, you actually might see some of the previous Biden appointees saying, for the good of the board and the good of the independence of the Fed, we might want to step down so that consensus can continue to build if they're not able to be part of that consensus.
Ed Mills of Raymond James. Ed, I have no doubt we'll be talking about this again sometime soon. Ed, thank you, sir. Danny, I'm pleased you brought up Robert Kaplan, the former Dallas Fed president who had to step down, resign because a lot of attention was put on his financial disclosures through the pandemic. And I pulled up this from 2024. It was a bipartisan letter to the Federal Reserve's Office of Inspector General, Senators Rick Scott and Elizabeth Warren, calling out the Fed's IG for failure to hold officials accountable for violating Federal Reserve rules. Look, it was bipartisan then. Why is it partisan now? That's the question I would have this morning.
By the way, Elizabeth Warren responded to this saying it's good to have pressure on the Fed, by the way, but this is the wrong type of pressure.
I'm not saying it's the right kind of pressure. I'm just saying we need to be consistent about this. If there is a legal process, and I've got no idea if there will be one, there isn't one right now, let's give it space to play out and see what happens. In the same way we did last time with the regulations around this Federal Reserve coming out of the pandemic. From New York City, more to come. This is Bloomberg. Live from New York City, welcome to the program. Equity futures down again on a 4-day losing streak. We're negative by 0.16% on the S&P. On the NASDAQ, we're down by a tenth. Heading into this, the Fed's Jackson Hole Economic Symposium kicking off today in Wyoming. Kansas City Fed President Jeffrey Schmid saying officials will be closely watching inflation data ahead of next month's interest rate decision. He spoke with Bloomberg's Mike McKee just yesterday.
This is, as you know, kind of an interesting month because we've got Jackson Hole and then we've got quite a few weeks of data to kind of pull in. So I'm really, I think everybody's quite interested in some of maybe the prints that happened in the last couple months and kind of where they go from here. So I'm like everybody. I think there was some fascinating conversations at the last FOMC. As you know, there were a couple of dissents. I think my interpretation of what's happening, especially in the labor market, is that the first couple quarters, a lot of business people were just saying there's uncertainty enough, and I think they kind of cooled a little bit on the higher side. But the most recent couple weeks that we've been talking to businesses in the district, there seems to be a burgeoning optimism again, that they've kind of digested and they've been agile enough to try to work their way through some of the new policies from the administration, and maybe going forward, maybe we'll see a little bit of uptick. That said, I still believe that the inflation number is trending closer to 3 than 2.
Well, we saw that in the minutes that, in general, the Open Market Committee felt that inflation was a bigger danger at this point. Would you say that's your view now?
It would be my view now. I think with an understanding that what may have happened in the first couple quarters on the labor side, which I think concerned several people on the committee, and me included. But I think this PPI was interesting, that print was interesting, but I really believe that when we talk to a lot of folks in our district, is that if you had to kind of lean or have a bias toward, it would be on the inflation side.
Maybe you've moved toward the middle in terms of whether you should hold rates or cut rates.
Yeah. You know, it's really fascinating. You think about, and you have great experience in this, when you get to the policy table, when you're talking about it, everything's connected to the dual mandate, right? And when inflation is really ramping up, you have a blunt instrument and you act, which is what we did. Now, as you get closer to the optimum dual mandate numbers, it actually becomes more difficult to make decisions on the margin relative to where that policy rate should go. And so I think that's where you're seeing a lot of the debate now is, where's your lean? Is it do you believe things are too restrictive on the policy rate side or not? I think they're modestly restrictive. I'm still trying to find ways, what's being inhibited in the economy from where our policy rate is today. But I think we're on a good path.
So at this point, it probably would be a mistake for Chairman Powell on Friday to say, definitely we're going to cut, as he did last year.
Yeah. I always can't wait for that speech. I think he keeps it close fast. I wouldn't front run him even if I knew, but I think that we've been doing so much work this year around the framework, around really getting into how we get this soft landing to 2% without breaking anything. So I think he has a lot of different directions to go, and I think it'll be a very anticipated discussion.
Well, how do you think you should communicate going forward? Because there are some people who are candidates for to be the next chair who say the Fed talks too much.
Yeah. Wow. Well, you hear both sides of that coin all the time, right? One, do we keep too much to our vest? Two, why aren't we doing more kind of transmitting future crystal ball or how are we interpreting the numbers to a future event? The SEP and the dot plot is maybe some of that, but I don't hear a lot that we don't talk enough or express ourselves enough. I think it's more important where the American public is concerned is they understand, we do a better job on helping them understand what we're doing and why we're doing it. And the dual mandate and the crispness of those two mandates help us a lot in the role we have.
I have to ask you about the latest presidential tweets and the attack on Lisa Cook, Governor Cook. I know that Fed officials will always say we don't let politics come into the boardroom. We do just what we think we should do on the economy. We don't even talk about it. But you've got to be getting sick of this.
No, well, look, I'm a little philosophical about the whole conversation of Fed independence and where our role is in the American economy. We're almost 250 years old as a nation. I think there's something to be said. We were built on words, and we continue to debate those words legislatively and judicially. Whatever friction we might have with other branches of the government, I think great steel's tested by fire. So we can always be better. We can always do this better. But I think the nature of independence and I think don't believe me, believe other nations that have central banks and don't. It seems to work, but I'm always open for the conversation of how do we make it better.
Well, do you think the Fed has suffered a hit to credibility by the constant attacks from Washington? I think the credibility issue is more in are we fulfilling our responsibility and role around the actions of monetary policy and monetary operations. And I think the work we do on behalf of the American people is very important to their lifestyle and their living. I want to make sure that our reputation stays strong around the things that we're mandated to do by Congress. Other than that, there's a lot of noise outside of that dual mandate. And look, you take this chair, you do this job, and people are going to have opinions, and I'm fine with that. When you talk to people, do they understand why you're not lowering interest rates?
Actually, it's interesting. So we're going to have two sets of folks that we would talk to. One are going to be business people and finance people that really, they understand it because they have to. I mean, I'm a former banker. You have to risk manage the cycles of rates to run your bank well and profitably. It's the general public that we continue to try to reach to give them some sense of what this dual mandate means to them. And I think there's a little bit of perfection in the healthy friction between full employment and stable prices. And I actually like that friction. And it allows us to kind of balance and rebalance what we're doing on their behalf. And it's 100% on their behalf. If you reach full employment and if you keep prices stable, people can work and thrive. And I think that's an important piece of what the Fed does.
That was the Kansas City Fed President Jeffrey Schmid sitting down with Bloomberg's Mike McKee. It is 5:30 a.m. in Jackson Hole, Wyoming. Sunrise in about 45 minutes or so. Mike McKee's safely and comfortably in his hotel room, I believe. Mike, good morning to you, sir. Fantastic exchange as always. This line stood out for us all. If you had to lean or have a bias towards, it would be on the inflation side. Will Chairman Powell be in the same boat tomorrow?
He's probably in the same boat. The issue is whether he will talk about it at length enough for us to know where he lands. And I think he's going to try to avoid that because at this point, they don't know what the next data are going to show. It was interesting, I thought, that Schmid, who has been one of the most hawkish members on the Fed and has pushed against rate cuts anytime soon, is now saying he's open to it if the data show that they need to do that. So if we get a bad employment report and a reasonably moderate inflation number, then you might see more people on the Fed than Waller and Bowman who are willing to vote for a rate cut in September.
Mike, what was interesting there is that we did get a bad employment report and he hasn't changed his views. So when you look at the Federal Reserve minutes from yesterday and everyone turns around and says they're super stale, they're dated, ignore them, I just wonder how many people have maintained those views from that Federal Reserve meetings, even with the payrolls report we got 2 days later.
You probably have most of the board retaining those views because basically it was 16 against 18 since Kugler didn't vote, saying that inflation was the bigger risk. And so there's a bias going into September that they shouldn't move, which is not at all what the markets think. And they're going to want to see the data. And again, it's going to come down to a question of how bad the employment report is and how bad the inflation report is. If inflation shows signs of really picking up, then probably September 17th is going to be a tough sell for a rate cut.
Mike, just quickly, the increased scrutiny of this institution, an institution that you've covered for a long, long time. It's kind of the elephant in the room in Jackson Hole, Wyoming now. The pressure that's coming from the White House and elsewhere in Washington, D.C. They clearly want to change this institution. They're clearly pursuing that objective in different ways. Mike, I just wonder what the reaction's been on the ground in the last few days while you've been there.
Well, basically, everybody agrees that something needs to change in the Fed's framework, which Jay Powell is expected to outline on Friday, because they put a lot more weight on employment in the last framework, and obviously inflation is now a bigger issue for most of them. And then the question becomes, what's the new leader going to do? What's he going to pursue in terms of Fed policy? Some have said, as we were discussing in the interview with Jeff Schmid, that the Fed talks too much. They should dial back on their commitment individual communications and try to explain more about what they're doing. But does that really make a difference in the sense of American people paying attention to this? Wall Street pays attention minute to minute, but do the American people pay attention to it other than basically when they go to the grocery store?
Second to second, never mind minute to minute. Mike, appreciate it, sir. Looking forward to your coverage. Michael McKee there in Jackson Hole, Wyoming, the latest on the Federal Reserve, that opening exchange with the Kansas City Fed president, the host of that annual get-together in Jackson. This is the line that stands out. Can you imagine if Chairman Powell turns around and says, if I had a bias, I'd be leaning to the inflation side?
It would be so painful. It would be really painful. This is a market that at one point was pricing in 100% odds that they'd be cutting in September. We've backed off of that, but still 80%. But I wonder, John, if he doesn't even need to go that far to upset markets. If he just gets up there and he says, we are data dependent, it matters on the labor market figures that we are going to see in the coming months, that in itself might be enough to rattle markets if he doesn't confirm a cut. And you add in the political pressure, why would he confirm a cut? He doesn't want to seem appearing at all to be caving into the pressure from the White House.
I've seen it in so many notes, just this one line in research notes across Wall Street. Not going to lock it in. He's not going to lock it in. He's not going to lock it in. That's even from people who believe he will be cutting interest rates a month from now.
But part of the crazy thing about that, too, is JP Morgan, their trading desk, had this note out saying we looked at FX, we looked at rates, and no one is pricing in event risk. No one is hedging around Jackson Hole because they think September is a lock. So even though the warnings are there, it could be an ugly day because it would seem that with positioning, people aren't prepared for it.
Chairman Powell's speech coming up tomorrow morning. Full coverage right here on Bloomberg TV and on Bloomberg Radio. Futures at the moment negative by 0.2% on the S&P 500. Bond yields bleeding just a little bit higher across the curve, up a basis point at the front end, up by 2 at the very long end. So that curve steepening comes back through. 2s at 376, 30s at about 492. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. The U.S. and European Union are finalizing the details of their trade deal and looking into carve-outs for key exports. The U.S. is committing to lower tariffs for specific countries on products like autos, aircraft, generic pharmaceuticals, and some natural resources. Officials are also considering cooperation on steel and aluminum tariffs. Meanwhile, Federal Reserve Governor Lisa Cook says she will not be bullied from her position. Cook responded in a statement after calls for her resignation from President Trump amid allegations of mortgage fraud from housing regulator Bill Pulte. Cook added she'll answer any legitimate questions about her financial history. And Vice President J.D. Vance says Russia wants some territory Ukraine controls as part of peace negotiations, while talks also include security guarantees for Ukraine. His comments coming as the U.S. is working to set up a bilateral meeting between the leaders of both countries to move negotiations forward, but a time and place have yet to be determined. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in the next hour, in about 30 minutes from now. Up next on the program, the dual mandate in conflict.
Now, as you get closer to the optimum dual mandate numbers, it actually becomes more difficult to make decisions. That's where you're seeing a lot of the debate now is, where's your lean?
Where is your lean? That conversation up next with the former Fed Governor, Betsy from New York. This is Bloomberg. Equity futures negative here by 0.2% on the S&P 500. Similar move on the Nasdaq once again following 4 days without gains on the benchmark stateside. In the bond market, yields creeping higher across the curve. 2s out to 30s, up a single basis point on 2s to 376. A steeper curve this morning, up 2 or 3 on a 30-year, creeping back towards 5, 492. 491.93. Danny, these comments from the Atlanta Fed President Raphael Bostic saying this on payrolls. The replacement rate could be 50 to 75K. Essentially, get ready for lower payrolls in our future. And going on to say the employment trajectory is potentially troubling, but one rate cut for this year is kind of still where I am.
I think it's really important to take both of these comments together to get an understanding with just how much they're viewing the labor market and how impactful and what the bar is to get bad numbers, to move them to cut. And this suggests that the bar is higher, that you need something uglier, because maybe this is a supply side story. Maybe this is because less people are coming in and Fed cuts aren't going to bring in more workers. So you have that on one side, and then on the other side, you have the Wallers of the world genuinely concerned. How does Powell bridge that gap when he speaks? It is a consensus that will be incredibly difficult to build.
This Federal Reserve is divided and finds itself in a tough spot. Under surveillance this morning, the dual mandate in conflict.
Now, as you get closer to the optimum dual mandate numbers, it actually becomes more difficult to make decisions on the margin relative to where that policy rate should go. And so I think that's where you're seeing a lot of the debate now is, where's your lean? Is it where do you believe things are too restrictive on the policy rate side or not? If you had to kind of lean or have a bias toward it, would be on the inflation side.
So here's the latest this morning. The Federal Reserve heading into Jackson Hole, facing down upside risk to inflation and downside risk to employment. The minutes from the Fed's last meeting indicating, quote, a majority of participants judge the upside risk to inflation as the greater of these two risks. The former Fed Governor Betsy joins us now for more. Betsy, welcome back to the program. It's good to lean on your experience, as always. Let's just start with the premise of the issue. Do you believe that we do see a dual mandate in conflict?
I'm not sure it's quite in conflict yet. When you look at the unemployment numbers and you go back to the last projections that the Fed did, the median participant thought that the long-term rate of unemployment would be at 4.2, which is exactly where we are. So I'm not sure that the number of jobs created because of supply-side issues, as you were discussing, is enough to consider that out of whack.
So, Betsy, going into this speech from Chairman Powell, I just wonder how much has actually changed for him since we got that payroll report a few Fridays ago.
I don't think a lot has changed. The payroll numbers are the most unreliable indicator that you get because they're so frequently revised, and the revisions, I think the average revision is 100,000 jobs. So that is huge. I'll tell you one story. When I was at the Fed with Jay, and we were discussing launching QE3, and there was a lot of concern amongst Jay, myself, and Jeremy about launching QE3, and we got a bad payroll number. We launched QE3. A year later, when you look at how that number had been adjusted, it would not have justified launching QE3 at all.
So then, Betsy, this time around, if he's having to deal with those inputs, but then also having to deal with Muslim, Daley, ironically Cook, who have all turned more dovish, does Powell necessarily need to incorporate those views when he speaks? Does he need to also have some of that dovish lean incorporated into his outlook? Because some of the rest of the FOMC is going there.
He is always aware of where every member of the FOMC is, because the job of the chairman is to lead. It's not to set policy and force everybody to agree. The job of the chairman is to lead and to know where all of the participants, all the members of the FOMC are at any given time.
If his speech, though, also has to do with cementing his legacy, Betsy, considering where we go from here, considering there will be a new Fed governor in 2026, you know the man well. What do you expect that to look like from Powell? What does it sound like to have a Fed chair who tries to come out and defend independence and have that legacy, but without provoking the politics of the moment and the White House?
So I think Jay Powell, in terms of his legacy, is looking at what happens to his mandate, what happens to inflation, what happens to employment, and how well does he manage that? It's not any single speech, and I would be shocked if he was viewing it that way.
Betsy, do you think there is a bias when it comes to handling and targeting inflation over, say, the prospects for the labour market? Do you have a bias? Is there an inherent bias on the committee to prioritise one over the other?
So everybody who comes on the committee ultimately gets labeled as a hawk or a dove. I don't think it's that clear cut. I think, for myself, I probably do have a bit of a bias on inflation because, I started my career in the 70s and the Volcker years when inflation was just out of control. But I don't think there's a real bias inside the room one way or the other. It's more a matter of which one seems the most difficult to manage at the time.
And what do you think is the most difficult to manage right now?
I still think inflation is much more difficult.
And do you think it gets harder in the months to come? Do you suspect we will see more pass-through from the tariffs?
Well, yeah, it's going to be very hard to determine once you start getting pass-through, is that pass-through a one-time price change or is it going to be persistent? And you really, they're going to be watching what expectations are. Inflation expectations are going to be the key over the next year or two. If inflation expectations get out of line, then the Fed will be very concerned.
But Betsy, isn't there an argument to be made, which Neil Dutta at Renaissance Macro makes, that it's the direction of travel that's troubling? That inflation, for the most part, has been traveling in the right way, but the labor market is traveling in the wrong way.
I just don't see that. I think inflation has been fairly steady. It hasn't been coming down as much as I would have expected if the current setting of monetary policy was as restrictive as some seem to think.
So, Betsy, just bringing it all back around about what we're going to get from the Fed governor tomorrow, do you expect there to be any change for how we view where the path of policy is after we hear from Jay Powell, or will tomorrow be inconsequential as far as that goes?
If where we means where we, the media, where we investors think policy is going, I think there may be a change because I don't see any chance that there's a nod toward a September cut or any promise of a September cut. I think he's going to focus primarily on the decision framework and not give any indication of where he's leaning for September.
Interesting. Betsy, thank you for giving us some time this morning. Appreciate it.
All right.
The former Fed Governor, Betsy Duke, there on the Federal Reserve. That's another one. Heard that a few times now already this morning, haven't we?
Yeah, that he's not going to give any sort of direction of where things will go. Again, I think this is a market that really wants him to solidify a cut. It's potential vulnerability on the front end that we've kind of backed off as. But I bring up JP Morgan again. Nobody seems to be hedging that we are going to get event risk, despite the fact you and I have heard from so many who have said he wants to leave the options open. Maybe he talks about data dependence, but certainly won't solidify that they're cutting in September.
My takeaway there on payrolls, to hear Betsy Duke talk about QE3 all those years ago, and to say that if we'd had the revisions that we actually got a year later, we probably wouldn't have done QE3, that's quite a statement.
I wonder if some people feel that way about the last decision, that if they had had the revisions in hand, maybe they would have cut.
That's the conversation we've had with the Treasury Secretary, Scott Bessent, who sat right there and basically said the same thing. Coming up on the programme, Sam Stovall of CFRA, David Bellinger of Mizuho, Claudio Irigoyen of Bank of America, and Meghan Robson of BNP Paribas. The third hour of Bloomberg Surveillance, just around the corner.
You don't want to have a scenario where tech and tech capex slows down.
There could be just overall concerns about what happens if financial conditions stay too tight and what that means for AI and AI capex.
Tech contributes to the aura that surrounds the markets.
We need to see a development beyond AI and cyber spend. We're wary of being involved for too long.
Time for a breather. Everybody was piled into the same trade.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Down every single day so far this week. 4 days going back to Friday without gains on the S&P 500. Equity futures, your scores shaping up as follows. We're down by 0.3% on the S&P, down another 0.2 on the Nasdaq 100. Later this hour, about 29 minutes from now, another read on the labour market in America. Jobless claims just around the corner at 8:30. Then in the next hour, about 9:45 Eastern Time, US PMIs in America, another read on the US economy.
I think the labour market data is going to be interesting. For one, it represents the NFP week, which in itself is interesting considering what the data has been doing. There are growing concerns about the labour market, but you see a market more sensitivity to, let's call it, the second tier of labour market data, just because there are questions of accuracy around the BLS data. So you can see more of an impact just on the weekly figures.
A huge theme for us so far this morning. Danny and I talking about it over the last 2 hours or so. Looking ahead to Jackson Hole, Wyoming, and Chairman Powell's address is just what hasn't changed for so many Fed officials. So we look at the Fed minutes from yesterday, stale, dated, whatever. They're super offside going into a really weak payrolls print. Minds have been changed. They cut interest rates in September. We've heard from a Fed official already, Kansas City Fed president sitting down and speaking to Mike McKee, who's basically not changed his mind at all based on that payrolls figure.
We also heard from Bostic giving a speech just moments ago saying that he could see one rate cut for this year. Those that are hawkish and where the bias is towards inflation are remaining there. That one print wasn't enough. So what do we get from Powell, it's unlikely, just given what we've heard from some of those governors, that he's likely to say, yeah, you're right, it's time. The time for change is now. We're going to cut. It's not going to be like last year of the time to adjust has arrived. So what happens if you have a Powell that kind of doesn't say anything, says we're data dependent? Is this a market that needs to do some serious readjusting?
That's the risk going into tomorrow morning. Coming into this hour, coming up over the next 60 minutes, we'll catch up with Sam Stovall of CFRA as markets level off after a two-day tech sell-off. Claudio Irigoyen of Bank of America reacting to Walmart earnings, and Meghan Robson of BNP Paribas as tension continues to build going into Jackson Hole. We begin this hour in Jackson Hole, Wyoming, where the Federal Reserve faces down a big decision heading into September. Lisa is there ahead of Chairman Powell's speech tomorrow. Morning, Bramo. What's in store?
Good morning, John. What we're looking at right now is three potential issues that really are at the forefront. The first and foremost is the political pressure, the idea of Fed independence, how much that's going to be very much part of the agenda, not just with Fed members themselves, but also Christine Lagarde of the ECB, Andrew Bailey of the Bank of England, all coming here to really fortify this importance of global central banking independence. The second thing is the framework review. That sounds boring. It is not. It has to do with inflation, whether they are going to target some sort of average inflation range, how they're going to reiterate the goal of 2% inflation at a time where inflation has not been below 2% since 2021. And the third thing that really is important is how they consider the labor market. Remember that the theme here is a labor market in transition. How do they consider a low payrolls number overall? Is this an issue of the supply side of immigration going down or the demand side? Weakness in the economy that they have to address with rate cuts. And those are the things people are going to be listening for to get a clue for what interest rate policy will be going forward.
Lisa, you and I have been to a few of these events together over the years. Does this one feel different for you relative to what's gone on before?
It does, because of the political interference, because of the political noise, because of the investigation that was announced into Lisa Cook, and this question of what President Trump has up his sleeve to try to get dominance over the Fed board. A question of what is the goal for reshaping the Federal Reserve at a time where there still is a plan to cut interest rates. In other words, how would a transformation of the Federal Reserve under President Donald Trump look so much different from the current Fed, which does seem biased to a dovish stance, even with inflation not having fallen below 2% since about 5 years ago. So this really is the key tension here at a time where a lot of academics have really beat the drum on the idea of central bank independence and how important that is in order to anchor long-term inflation expectations.
Lisa, just before you go, UTK and Mike McKee will have a special program tomorrow morning from Jackson Hole, Wyoming. Who are you looking forward to speaking to? What are the big names we need to look out for?
Well, Susan Collins, of course, will be joining us. Kate Moore will be joining us as well. We're going to be speaking to a whole host of different policymakers. I'm actually very interested to hear what the head of the German central bank has to say, in particular about global central bank independence at a time where there's a real question of whether we're entering a new inflationary regime. We're going to be speaking with him as well tomorrow morning. So a real question here about the role of central banking in a pivotal moment where the economy is very much hotly debated on Wall Street, just as much as it is behind closed doors among academics.
Bramo, looking forward to the conversations tomorrow morning. Get some rest. Lisa, thanks for waking up early. Appreciate it. Thank you very much. Lisa Abramowicz there in Jackson Hole, Wyoming, ahead of that big speech tomorrow morning from the Fed Chair, Jay Powell.
There's a lot at stake because he's stuck between a rock and a hard place on multiple fronts, be it the inflation picture versus the labor market, be what tariffs are going to be doing, and of course, the 1,800-pound gorilla in the room. I don't know how much they weigh, but that is the politics. Sorry, the bear in the room.
Grizzly bears,
yes.
Which is why I'm not there. I'm petrified of them.
Yeah, you're not likely to run into one here, so great
Bramo
choice.
goes hiking, which is absolutely nuts. You have to go around with the bells to make sure the bears know you're coming.
Yeah, I was going to say, I think if you see a bear, you're supposed to make yourself really big and yell so you don't startle it, so they're very aware of you and slowly back off. And apparently the worst thing you can do is run. If I'm seeing a bear, I'm running.
If you see cubs, you're probably done for, which is why I want nothing to do with it. Good luck to you, Bramo. Apparently, I was told, Mike McKee told me a long, long time ago, you just have to be faster than the slowest person. That's the secret here.
That's good.
Which is kind of gruesome when you think about it. All right. Here's a view on Wall Street this morning. Sam Stovall of CFRA writing this. Even though the inflation picture has become a bit murkier, CFRA still expects the FOMC to cut rates by 25 basis points at both this September and December meetings. Sam joins us now for more. Sam, welcome to the programme, sir. Let's just talk about expectations going into tomorrow. Is there some scope for disappointment here ahead of Chairman Powell's speech?
Well, I think so. The disappointment could come in that he's not going to be dovish and giving any kind of a signal that the Fed will be cutting rates in September. People have asked me, well, is he going to make some sort of a statement because it will be his final Jackson Hole meeting? And my thought is, no, he's not going to sound like Douglas MacArthur speaking to Congress after he was let go by President Truman. He might end up sounding more like Stonewall Jackson saying, we're going to focus on the data. We're not going to be driven by political desires. And so as a result, we have so many more data points between now and the September FOMC meeting that's what he's going to say is we're going to monitor that data.
What happens to risk assets? What happens to bonds if he does that, Sam, on a market that's gotten excited pricing in a September cut?
Well, I think that the bond market might actually breathe a sigh of relief because if we have too dovish of a Fed, if we have too many rate cuts, I think the bond vigilantes are going to step in and say, wait a minute, we already have a problem with inflation. Expectations are that we're going to get a 2.9% year-on-year core PCE print at the end of this month, and it could be rising above the 3% level before year end. And at the same time, probably seeing fewer than 100,000 new jobs created between now and year end with each monthly print, and unemployment rate challenging the 4.5% level. So I think that the bond investors will probably say good for the Fed because we need to do more to fight inflation.
Sam, some of those concerns you're laying out that might be relieved, is that part of what's playing out in the long end of the curve right now? A 30-year yield near 5%, a 530s curve that is the steepest since 2021. Is it reflecting some of that stubborn inflation and a bond market that's too worried about a FOMC that's overly dovish?
I think that certainly is a possibility, and that could be a reason why we've seen a digestion of 3.5% for the tech sector, or I should say, 3.5% for the tech sector, but a lesser decline for the S&P 500 since the August 12th high. And I think investors have to reevaluate where we're going.
So, Stan, we just got this headline. It just crossed, Sam, from Walmart. They said the CEO says tariff costs are increasing each week. This, I keep saying, Sam, is a process and not a one-off event. How do you see this playing out in the months to come? Because we heard from Goldman Sachs in the last week or so that they see companies taking this on margin for now, but they think in the next few months it gets passed on to the consumer. How do you see things playing out?
Well, there's that old saying that the consumer stops spending only when the banks stop lending. So the consumers will probably continue to spend. But the question is, will companies like Walmart continue to pass along some of those higher prices? They were absorbing most of them early on, but they did say that they expect to see better sales as the year progresses. TJX said the same thing, ditto for Lowe's. So I think in general, the retailers surprised to the upside. And so the real question is, when will the tariff effects take place and be found in those numbers? So consumer discretionary, we have a market weight on right now. We do realize that that's where you could be pretty cautious, because if things do change, then it could cause investor sentiment to decline, as well as consumer expenditures.
Sam, what do you think we're pricing here? Aren't we pricing a reacceleration in growth in this economy?
Reacceleration up to 2%, down from or up from about 1.8% is our forecast for the third quarter. So I don't really regard that as an acceleration. I did hear an earlier guest speak about the possibility for GDP growth in the upper 2% area for 2026. Our expectation is that that's a bit optimistic, but we don't think that we are headed for a slow slowdown nor, in particular, a recession. That's what we experienced earlier in the year. I like to say that bull markets don't die of old age, they die of fright. And what they're most afraid of is recession. And when that came off the table, that's why we ended up with a near 30% rebound in the S&P 500.
Hey, Sam, appreciate your time. As always, Sam Stovall there of CFRA on this equity market. Equity futures, Danny, taking another leg lower, down about 1/3 this morning.
Yeah, it's this slow bleed lower that has been led by tech that's made us all look back and try to come up with that whatever silly little reason that we can. I wonder how much Walmart is going to color things from here in the good earnings that we've heard from, saying that prices only rose by about 1% in the second quarter. What happens when they replenish their inventory? Are we going to look at Walmart as really the poster child for the companies that have had solid earnings this quarter, but margins come under some serious pressure and prices change later on in the year?
This is the issue that we've all got, including the Federal Reserve. All that pre-tariff inventory that was accumulated by all of these companies ahead of time, well ahead of the time. They've been working through all of that. So how much signal versus noise has there actually been in the inflation prints we've had so far? That's the big problem, not for us, for the Federal Reserve. They've got to set policy next month.
Well, again, Walmart really underscores that there are mitigation strategies to tariffs that companies have been able to do. The problem with those strategies is eventually they stop working when you need to replenish some of the items that have already sold and the warehouses in the inventory you have. So yes, profitability held up well in the second quarter. What happens in the third? What happens in the fourth?
Futures this morning, another leg lower, down 1/3% on the S&P 500. For an update on stories elsewhere this morning with your Bloomberg Brief, here's Yahara. Hey, Yahara.
Hi, John. We are seeing Walmart shares going even lower, 3.3% as that earnings call is underway. The company posting a rare miss on earnings due to higher insurance claims. Also, the retailer did raise its full-year guidance, and stores open at least 1 year saw sales higher than expected. The CEO saying on the earnings call moments ago that tariffs are adding to costs each week. Meanwhile, we're seeing Boeing shares moving in the opposite direction, up 1.2% in the early trade after reports that the plane maker is finalizing a deal to sell as many as 500 aircraft to China. Sources telling us here at Bloomberg that the sale would depend on lowering trade tensions between the U.S. and China, and that talks could still fall apart. Chinese officials have begun asking airlines about how many Boeing planes they would need. And the U.S. and European Union are finalizing the details of a trade deal and looking into carve-outs for key exports. The U.S. is committing to lower tariffs for specific countries on products like autos, aircraft, generic pharmaceuticals, and some natural resources. Officials are also considering cooperation on steel and aluminum tariffs. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next, the morning calls, plus David Bellinger of Mizuho reacting to Walmart's mixed earnings report. Live from New York City. You're watching Bloomberg TV.
I think we've already seen the broadening out. The second best performer is industrials. That's a broadening. Third best performer year to date is utilities. The Utes up 13.3%. You're going to tell me that it hasn't broadened? Consumer discretionary, the consumer, remarkably resilient. I think it has broadened.
John Stoltzfus of Oppenheimer working the Bloomberg terminal earlier on this morning. We should hire him.
Yeah.
Just sitting there, loaded up the Bloomberg, breaking it down, what has performed, what hasn't.
I was going to say, I feel like someone on the Bloomberg News equities team is going to call him up and say, hey, we need a data recap from John Stoltzfus every day.
Love John. Still bullish this equity market. Likes the rotation he's seeing. Equities this morning, negative. We're down again. We're off by 0.4% on the S&P. Following 4 days without gains, we add to the move. Could it be day 5? On the Nasdaq 100, after 2 big days of big tech weakness, we're down by another 0.4%. That's the price action. Here are your morning calls. First up, Wells Fargo raising its price target on TJX to 130, saying its earnings had, quote, little to no holes with upside across the board. Your second call from Wedbush downgrading Instacart to underperform, saying intense competition and value-driven consumers may erode market share. And finally, Piper Sandler raising its price target on Lowe's to 294, seeing a bullish second half of the year. Let's stick with retail. Walmart shares falling after its second quarter profit missed expectations for the first time in 3 years. Following the name, David Bellinger covers Walmart for Mizuho with an outperform rating and a 115 price target. David joins us now for more. David, good morning.
Good morning. Thanks
Welcome
for
to the
having me.
program. Great to see you. Let's just talk about your first takeaway, your initial impression.
Yeah, so you got the shares down pre-market here. This was a strong top-line quarter from Walmart, but we didn't get the flow-through. And they're talking about some of these self-insurance costs that sort of sideswipe them here in this print. And if you look at that, it's about 4 to 5 cents, and that represents pretty much the miss here. But overall, we think the core of the business is performing fine.
They also noted, sorry, John, just to jump in, they also noted that prices only rose 1% in the second quarter. Does that change?
That's right. So yeah, it was 50 basis points in Q1. Q2 was 1.1%. We should see this gradual phase in. And Walmart CEO Doug McMillon, he was just talking about each and every week the prices going up as the tariffs start to roll through. So that's very much expected. And I'd say so far we haven't seen any evidence of the consumer pushing back to a great degree. They've sort of eaten it and absorbed pretty well. That's the question, though, into the back half as prices get higher and higher, what happens to spending in general?
It was weird, though, because the CEO's comments were, this is a resilient consumer, but also higher-end consumers are now shopping at Walmart. Those two things would seem to be in tension. So looking at Walmart's earnings, how resilient does the consumer actually seem?
Yeah. Great question. I think the consumer is incredibly resilient. I think the consumer is feeling good right now. And Walmart's had this big win on these mid to upper income consumers. A lot of not necessarily trade down, but I think this is their online business has gotten really strong with this Walmart Plus membership. That's where they picked up all these upper income type consumers to go along with the low income. So it's more of a Walmart specific thing that they've gotten a lot of these new customers. But yeah, it's pretty much anyone can shop there, and they've got really great merchandising that resounds with everybody.
Who are they taking that business from? Who's losing customers?
Yeah, it's all over the place, really. So it's probably a little bit at Amazon because they're starting to build out their marketplace now, Walmart, and they've got about 700 million items. That's about a quarter of what Amazon has. So you're starting to see that build up, but it's really across the board, small independents, mom and pops, but Target's had issues, and I think Walmart's picked up a decent amount on that.
Target's got issues. Disappointment yesterday. What did you make of the disappointment? What was it all about?
Yeah, so the quarter was weak. Everyone knew that. It got a little better as it progressed, but still weak overall. And then this new CEO hire, Michael Fidelki, investors wanted an outside hire. They wanted an external candidate. About a month ago, we ran an investor survey and it was almost unanimous. We had 96% of investors said we want an external candidate, someone who can come in and be really aggressive and bring wholesale change, maybe be disruptive to a certain degree. That it seemed like Fidelki was not the guy people wanted. Not to discredit his 20-year plus career at Target, started as an intern, worked his way up, so he knows the business really well. But investors didn't see him as the right guy at the right time to come in and sort of tear this thing apart and start over.
This happened a lot since COVID. A lot of C-suite changes as kind of being the prescription to try to turn around companies. Just looking at some of the examples, you had Starbucks bringing in someone over from Chipotle that necessitated changes at Chipotle. Nike, things change. How successful have these CEO changes been? A few of them, we've had a couple years under the belt. Are they the right strategy for a company that is struggling to do a change at the very top?
Yeah, it could be. It depends on the company, it depends on the retailer. These things can tend to be a little, let's say, ugly at first, right? You could have these big earnings revisions down or companies clearing guidance to set a low bar, but then it takes several quarters and tends to be pretty expensive to fix a business. One that I'd point back maybe 6-7 years ago now was Lowe's. Lowe's always underperformed Home Depot. They brought in Marvin Ellison, who actually was the head of stores at Home Depot years ago. Took a while, but they've caught up. So it's not easy to do, and especially when you're in the public view, being a public company, you've got competitors looking at all these changes you're making and trying to step on your throat at certain points, right? So that makes it incrementally more difficult. But yeah, it's definitely possible. And one other thing I'd say is a lot of companies throughout the COVID stimulus era, I'd say they sort of lost their way. A lot of work from home. We saw this at Five Below, we saw it at Target. And this is a way to sort of recalibrate all that, get a new management team in and sort of clean everything up again.
It's funny, you talk about the tension being a public company and your competitors can hear what you're doing. you also have a White House that can hear what you're doing. And it's a president that specifically has called out Walmart before for raising prices, saying that you should be eating the tariffs. How much do you think that colors what we're hearing from Walmart and the kind of things that the CEO is saying, again, saying that tariffs are impacting things week from week? Do you think that's a complete, honest and clear readout? Or could things be worse, but they don't want to articulate it because they know that the president might be listening?
Yeah, I would say Walmart is probably the most honest company that I follow, and they've got great data. They give us great updates. I know they're in constant dialogue with the White House on tariffs or just the state of the consumer. So what I read into from these comments of Walmart is they're probably the most honest of anyone, talking about these price increases and how the low-income consumer might be not necessarily wobbling, but a little bit weaker. But I sort of trust Walmart, and they've got great data to support all this.
I don't think you can overstate the importance of that meeting that took place in the White House between the biggest retailers in this country and the president. I believe that was a massive factor in a change of an approach to the tariffs that we eventually saw from the White House, from the president, and from the Commerce Secretary, Hamid Lutnick.
Because the fear was empty shelves. If they went to the president, they said it could roll around to Christmas time and there could be empty shelves. Just think about the backlash from the consumer. So finding a way to mitigate that, I think, was really important for the White House and going forward for the tariff policy.
It's a pretty powerful message coming from the company this morning. The CEO saying that tariff costs are increasing each week and that higher prices are affecting low and middle income cohorts. That's coming from one of the biggest retailers on the planet, speaking directly to us, to the investor, sure, but also, as you've pointed out all morning, to the White House.
Because, again, we know that the White House listens to this. He did it in May when Walmart said that they were raising prices. But again, it's also Walmart that said that the consumer is resilient, so there still remains a bit of tension there.
David, before you go, top pick, 30 seconds. What is it?
So we like Lowe's. Lowe's coming back from sort of this housing recovery, right? So it's we've seen that play out, sort of starting to get better. We like Walmart on the e-commerce side, actually, because they've got about $100 billion annual revenue run rate in the U.S. That's second only to Walmart. You're seeing the profitability pick up there as well.
Amazing. David, good to see you.
You too. Thank you.
Thank you for dropping by. Appreciate it. David Bellinger there of Mizuho. Up next on the programme, some jobless claims data, the last big data point going into Chairman Powell's speech tomorrow in Jackson Hole, Wyoming. We'll get the thoughts of Claudio Irigoyen of Bank of America. Here to react from New York City. You're watching Bloomberg TV. The up and about, 60 minutes away. Data, 20 seconds away. Equity futures negative by a third of 1% on the S&P 500. Likewise on the Nasdaq. On the Russell, we're down by 0.6. In the bond market, as we wait for jobless claims, 2-year, 10-year and 30-year bond yields just inching higher by about a basis point or so across the curve. Up by 1 on 2s, up by 2 on 30s. Your 30-year bond yield, 4.91. Jobless claims about to cross the Bloomberg terminal. Let's cross over to Mike McKee to get a read on things. The estimate, 225. The previous number, 224. With some economic data, let's cross over to Mike McKee in Jackson Hole, Wyoming. Good morning, Michael.
Good morning, John. What we've got is 235,000, which is an increase from last time, but it is not as bad as people might have expected. It's certainly above the 225 and maybe a hint that things are turning around. But remember, this is sort of back to school time. So we're going to see some ups and downs in jobless claims. 1,972,000 is the continuing claims number. That's up from 1,942,000. So we do see there another indication that people are not getting jobs as quickly. Philadelphia Fed number comes in with a slight gain there actually it falls. I'm sorry, read that wrong. Negative 0.3. The estimate was 6.5. The prices received index is down and the prices paid index is way up, 66.8 to 58.8. So that's something that people are going to be keeping an eye on, given especially what Walmart said this morning about prices continuing to go up. We're starting to see it in all of the indicators. So for Wall Street, that might be more of an indication indication of what's going on than the jobless claims numbers. We'll have to see over the next couple of weeks if jobless claims continue to rise.
Yeah, Mike, I'll come back to you on that in just a moment. Just want to take a beat on the market. Really muted price reaction in response to this. Yields at the front end of the curve were up by, let's call it a basis point on 2s, now just about unchanged, up by close to 2 basis points on 30s, now up by only a basis point at 490.70. So not a major move. And off the back of that, with that change in yields, just a bit more dollar weakness. So on the session, euro dollar pretty much unchanged on the day now at 116.47. If you're interested in the equity backdrop, equity futures still near session lows. No real movement off the back of this at about a third of 1% lower on the session so far on the S&P and on the Nasdaq 100. Might want to come back to you on the data. You mentioned it. Not reading too much into initial jobless claims, but there is a theme emerging in continuing claims. If you're out of a job in America right now and you continue to be out of a job, it gets much, much harder to find a new one, Mike. Is there some signal there for this committee into September?
Well, given what they said at the minute meetings that were released yesterday, it may be a little bit of a signal, but not one they're totally concerned about yet, because we did have the big revisions to last month's numbers, and what we saw was no hiring, but we didn't see the unemployment rate really rising significantly, and that's the figure that the Fed officials are going to be looking at for deterioration in the labor market. This just seems to be another case of what we have been seeing for a while. Companies sitting on their hands, waiting to see what happens with tariffs, waiting to see what happened with the big bill, and waiting to see how that was going to affect their plans. Now, you heard Jeff Schmid talk earlier this morning to us about how he's hearing from companies that they're feeling a little more optimistic these days now that they have a little more clarity. So it is going to be interesting to see if these claims numbers and continuing claims numbers turn around. But again, I think people are going to be paying a lot more attention, and the Fed officials suggested this, to what is happening with inflation. And in that, we get the bad Walmart news, and we get the Philadelphia Fed prices paid index going up significantly.
And Mike, do you think that's where there could be some surprise from the speech with Chairman Powell tomorrow? The market and Wall Street very focused on the payrolls print from a few weeks ago, but a Federal Reserve that's still laser focused on its inflation mandate?
It will be interesting to see if he reinforces what came out in the minutes, because if that's the case, the minutes clearly gave Wall Street something to think about and whether or not they're leaning too far in the direction of rate cuts. So if he makes inflation front and center for them, then yes, I think we could see a more dramatic repricing tomorrow than we've had in a while.
Mike, thank you, sir. Looking forward to your coverage. Michael McKee in Jackson Hole, Wyoming, with the sun just coming up behind him. Upside surprise on jobless claims and continuing claims. Equities just about unchanged. The bond yields still start to make a move. We were up a basis point or two across the curve, just about unchanged now at the front end on 2s. The 2-year, 10-year and 30-year look like this. If we can switch out the board, could take a look at bond yields right now. Yields unchanged on a 2-year at 374.55. With us around the table, Claudio Irigoyen of Bank of America joins us now for more. Claudio, good morning. It's good to see you. Going into that payrolls report last time around, based on the minutes that we've all seen, this Federal Reserve sounds tremendously offside. Labour market's solid. Only 2 people on the committee seem to be worried about it. They are putting all the emphasis on inflation. How much changed with that one report and all those revisions?
I think the most important thing to think about the labour market is to think in terms of unemployment rate and vacancy ratios, because you're having also a supply shock, which is the tightening of immigration, that makes the reading of payroll a little bit tricky, because you can have a supply-driven reduction in payrolls that doesn't increase unemployment rate, and therefore the Fed should not overreact to that revision. It's going to be interesting how Powell frame it tomorrow. I think Powell tomorrow probably will tell the market that September is not a done deal, because this is a stagflationary environment. It's going to be probably lower activity, probably higher inflation, and the Fed will have a tough job deciding which one to sort of not ignore, but which one to pay more attention to.
Claudio, you though say no cuts. You make the case for no cuts this year, but there are plenty of people who look at this labor market and say, sure, supply is playing a role, but still you're finding companies who are not hiring people. Just look at the continuing claims, that the trend is one of weakening, and that in itself necessitates cuts before it's too late. What do you say to that?
I would say that companies are facing a lot of uncertainty, and when you face uncertainty, you are more careful about hiring, you're more careful about firing, and you are more careful about increasing prices because you don't want to lose market share. So we're going to see tariffs on inflation. We are starting to see that, and we're going to see it more over time. The way Trump negotiated with countries like 50% tariff and you have 90 days to come up with a plan gives companies a lot of incentives to front-run imports, build cushions, and therefore you're going to have probably not a spike in inflation, but a lot of persistence towards the end of the year.
The runway's longer.
Yes.
Does that make the job easier for the Fed?
No, much more difficult, because the problem they might have, I think Powell thinks in terms of, okay, let's suppose I make a mistake. Which one is more costly? Cutting rates and then inflation peaks in December or January at 3.2, 3.3 core PCE, or staying on hold and then unemployment rate goes up. And I think, credibility-wise, the first one is a bigger cost, the first mistake.
So would you also say then, looking at the revisions we had, captured that uncertainty, does that mean that the next payroll report could look stronger? And if it doesn't look stronger, does that mean it's something more than just uncertainty? Now that we have more of the tariffs, more of the rates, more certainty under our belt?
Could be. We estimate that equilibrium payrolls, which is the number of jobs that you need to create to keep unemployment rate constant, went from probably 110, 120 when you had the immigration boom to something like 70. And we estimate payrolls towards 50K towards the end of the year. So you're going to have some demand destruction, but a big chunk is going to be supply. So as long as unemployment rate that does not shoot up, the Fed will not overreact to those numbers.
What you're saying is really important. So let's go through it. I want to give you some more time. What you're essentially saying is you can have a massive step down in payrolls growth, but not an increase in slack.
Yes.
And labour market slack should ultimately be the focus of this Federal Reserve.
Yes.
Can the chairman articulate that tomorrow in a speech without sending this market nuts?
I think the chairman will say two things. Will say sort of what he said in the press conference, and you can transpire from the FOMC minutes yesterday. And he will say, look, there is a tremendous amount of uncertainty. We have two more payroll numbers because we have one revision and one payroll. We have one inflation print, and we need to balance the risks. And I think he will talk a lot about risks. And I think probably, given that is the last speech as a chairman, assume that it's the last speech as a chairman. I don't think he's going to be reelected, or reappointed. But as the last speech, he will probably put a lot of focus on the importance of preserving price stability.
So if he puts a lot of focus on that, that would be writing off a lot of the other changing views at the Fed. You've had Cook, Daly, Musalem, a lot of the more kind of maybe hawkish leaning ones start to sound more dovish and saying that that last jobs report did change their mind. Does Powell need to reflect any of that?
Look, I think there is still consensus that inflation is still the biggest risk. That's why I said before, I think it's going to be important how Powell conveys the message of the revisions. Is that important or not? We haven't seen yet an increase in unemployment rate. Unemployment rate today is 4.2%. A year ago, unemployment was 4.2%. And the path for tariffs, the path for inflation doesn't look great. And you're going to be probably, at the end of the year, 1 percentage point above the target. So ironically, you are further away on your inflation target. You have a more deviation from your inflation target than from your employment target.
So if you do have a Fed, though, that decides to cut, and they're cutting because of labor market weakness, that to what you're saying is more due to the supply side, that cuts don't actually help, what happens at that point? How big of a policy mistake would it be to cut in this environment?
We want to see right away, 2 months later, what happened to inflation and to the labor market. But I ask this, I'm a company. I have a lot of uncertainty. I don't know how the rules of the game are going to look like 6 months from now. I'm not going to invest because interest rates are 75 basis point lower? Probably not. So you risk the dynamics of inflation expectations, and you're not going to gain much in terms of employment, setting politics aside.
They're nervous they have to move in the other direction. I sensed that from the Atlanta Fed President Raphael Bostic. I think he said as much, that once you want to move in one direction. The risk being that you cut rates now and you have to do something else that you don't want to do further out. The source, I think, The biggest source of tension right now, potentially, is a Federal Reserve chair that focuses on one side of the mandate, inflation, when the market's focused on the other side of the mandate, employment.
And how can the Fed and how can Powell refocus them on inflation if it's a market that is so moved to one side? Because you even look at the FOMC minutes, for example, and could say, look, the readout of that was a great opportunity to shake this market and say inflation is more important to the Fed. And what happened? It was a market that was little change and wrote it off as outdated and stale.
Forget about that. They're still cutting in September. Seems to be the bias at the moment. Claudio, appreciate your explanation of things. Thank you, sir. Claudio Irigoyen there of Bank of America on Chairman Powell and that big speech tomorrow morning. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahira. Hey, Yahira.
Hi, John. We're seeing Boeing shares rising 1.5% in early trading after reports that the plane maker is finalizing a deal to sell as many as 500 aircraft to China. Sources telling us here at Bloomberg that the sale would depend on lowering trade tensions between the U.S. and China and that talks could still fall apart. Chinese officials have begun asking airlines about how many Boeing planes they would need. Meanwhile, Meta is temporarily pausing hiring in its artificial intelligence division while it structures its new superintelligence efforts. A Meta spokesperson saying on X that the company is pausing to, quote, plan and forecast after hiring new people. This was in response to initial reporting from the Wall Street Journal. And Sony's PlayStation 5 is getting a price hike in the U.S. The video game console will go from $500 to $550, while rivals Microsoft and Nintendo already raised prices after tariffs increased the cost of imports. Sony has sold more than 56 million PS5 consoles since its 2020 release, beating Microsoft's Xbox Series S and X in sales. That's your Bloomberg Brief. John?
Yahira, thank you. Up next on the programme, we'll set you up for the day ahead. Plus, Meghan Robson of BNP Paribas joining us with an eye on Jackson Hole. And Yahira back with us with your morning movers as Walmart's profit miss overshadows its higher sales. That stock is down by 3%. From New York, you're watching Bloomberg TV.
Jay Powell, in terms of his legacy, is looking at what happens to his mandate, what happens to inflation, what happens to employment, and how well does he manage that. It's not any single speech. He's going to focus primarily on the decision framework and not give any indication of where he's leaning for September. Inflation expectations are going to be the key over the next year or two. If inflation expectations get out of line, then the Fed will be very concerned.
That was the former Fed Governor Betsy going into Chairman Powell's speech tomorrow in Jackson Hole, Wyoming. If you are just joining us, welcome to the programme. Equity futures shaping up as follows going into your opening bell 42 minutes away. Futures are negative. We're down by 0.4% on the S&P. Likewise again on the Nasdaq. It could be day 5 without gains on the S&P 500. With less than 1 hour to go, let's get you some morning movers. Let's cross over to Yahira, who has more. Hey, Yahira.
Hi, John. We start with Walmart. Shares are falling 3.2% as investors digest cost pressures highlighted in the earnings call. The CFO saying that inventory costs are rising due to import expenses, while CEO Doug McMillon is warning that tariff costs are increasing by the week and that they're starting to see price hikes affecting how low and middle income consumers are spending. So taken all together, they are not painting a rosy picture when it comes to consumer spending or margins, because let's not forget they posted a rare profit miss in the second quarter. And we move on to another consumer stock, also not painting a rosy picture on the consumer, and that is Coty. Shares are getting decimated, down 20% after disappointing results. And what they're saying is that sales could drop as much as 8% in the current quarter and keep sliding into December, as they warn that retailers are cutting prices to clear inventory at a time when they say shoppers are pulling back on non-essential spending. And we end on Boeing. Shares are up 1.5% as we reported the playmaker is nearing a huge deal with China that would involve Boeing potentially selling as many as 500 aircraft, which would finally break a sales drought that's been going on since 2017. But this isn't just about jets. We're reporting that the order could be the centerpiece of a bigger U.S.-China trade deal. John?
Yahara, thank you. Just want to pick up on a few things Yahara said. One was on the consumer. Consumers pulling back on non-essential spending. If that's the case, big call to make over the next 3 months. Either it bounces back or corporate America's got some really hard decisions to make about what they do with costs. Do they pass them on or do they need to cut them themselves?
I was going to say, if there are already signs that consumers are starting to pull back, what does it mean for margins that have started to come under pressure, which suggests that they haven't passed on those prices yet? They haven't passed them on, and yet the consumer is pulling back. If they need to start to try to preserve margin, does that mean instead of raising prices, they do things like firing workers, for example, and then it impacts this labor market?
A dual mandate very much in conflict for this Federal Reserve as we count you down to Jackson Hole. Meghan Robson of BNP Paribas saying, we believe the Fed will not want to disappoint the market. Chair Powell may acknowledge labour market weakness, which could be enough to support a continued grind in credit. Meghan joins us now for more. Meghan, good morning.
Good morning.
Let's start with the Fed, then we'll get to credit. So the chairman tomorrow, you say you won't want to disappoint the market. Others have come on the programme and said maybe he needs to introduce some two-way risk here. Why one and not the other?
So I think expectations in credit are for a dovish outcome. If you look at the previous payroll report where we saw some downside since then, credit has really grinded tighter. We think that, similar to the rate, the pricing you see in rates reflects that there is this expectation that the Fed will shift dovish in September. Will Powell signal that he will begin cutting in September? We don't think he'll necessarily go as far as that, but even if he's able to recognize some of the hiccups in the labor market data, we think that could be enough to sort of contribute to this positive tone that we've seen in credit and allow investors to focus their attention ahead to the September 5th labor data that we'll be getting.
High yield spreads are tight. Investment grade credit spreads are super tight, tightest since the late 90s, 98?
Yes.
I believe. OK, so let's work into that. How much of that is a reflection of the economy and how much is just an expectation the Federal Reserve is about to cut interest rates?
I think it's a bit of both, but actually the key driver we think has really been the technicals. So you have this secular tailwind all year where elevated yields has supported credit from two angles. One is the supply. So issuers are less likely to take on more debt issuance if they don't have to. So you have this sort of deleveraging dynamic. And then at the same time, yields are elevated, which has been very attractive for yield buyers. So that force, we think, will still stay in place. Yes, spreads are tight, but we think there's potential to stay here, even go tighter into the end of the summer, given sort of that secular dynamic.
How much tighter? Is there room to go tighter at this point, Meghan?
Well, I think if you compare today's market to the past, there are some important differences. For example, bond prices are lower. You can argue that means spreads could be tighter. Also, ratings quality is a bit higher. So things like that, I think, can support tighter tights from previous periods. I think there's also two other factors that come into play. So the market sentiment for the second half of the year, we think is already pretty bearish. So if you look at forecasts for growth, for inflation, there's sort of a stagflationary bias. So the bar to surprise to the downside is quite elevated.
Citi did this research on the credit market, basically looking at past instances where you have macro uncertainty or policy-driven uncertainty factored into credit. And they said just based on that credit spreads are too tight, and it leaves tight and leaves us vulnerable should you get one bad piece of data or another piece of policy that really starts to rock things. Does the tightness of credit spreads at this moment make us more vulnerable to dislocation?
It certainly is vulnerable in certain pockets of the market. And one I think would highlight is if you look at earnings season in second quarter, IG earnings generally very strong. High yield also at the high level was strong. But we did see some of the lower quality CCC issuers that missed earnings. They really saw substantial price drops, sometimes greater than 10 points in bond prices. So for those credits, I think that there is much more vulnerability. But overall, we're in mid to double-digit or mid-single-digit to double-digit earnings growth in second quarter. That's much better than we expected. So looking at the corporate data and earnings, it's still quite positive.
Do you think there's a chance that a lot of these credits could trade inside of Treasury yields?
Not wholesale by any means. I think there are some credits and some maturities where we've seen credit trade slightly below.
What's behind that? What's driving that?
I think it's partially this bond price level. So a longer dated maturity, say if your price is at a 60 or 70 handle out of 100, then you can say, well, I don't have much downside from here. And so your spread may be much tighter than it otherwise would have if it was a par bond. So I think it's that. And then a lot of those names are in the much higher quality investment grade sector. So tech, where you have a massive amount of cash on the balance sheet, and the credit quality is much more stable.
Meghan, appreciate your time. As always, thank you. Meghan Robson there of BNP Paribas. Some confidence in corporate America where there might not be much in the balance sheet of the sovereign.
I still love that question, because you could buy something like a Microsoft, you get access to that cash flow, and it really makes us rethink what is haven, what is safety. Are you more likely to buy corporate bonds instead of treasuries to get a ballast in your portfolio, just given all those factors?
Credit spreads are super tight. As we count you down to the opening bell, here's a sneak peek of the trading diary through the rest of the week and into next. Today, the Jackson Hole Symposium kicking off at 9:45 a.m. We'll also get PMI data. 3 p.m., President Trump signing executive orders. And then Friday, the big one, is remarks from Fed Chair Jay Powell in Jackson Hole, Wyoming.
And to what degree does he enforce or not enforce a rate cut to come? And how much is the market going to have to adjust their expectation at the moment, just under 80%, that we will get a cut? It could be a big shock for this market if he introduces two-way risk.
Danny, enjoyed this. You back tomorrow?
I'm back tomorrow. You've got more of me.
Good stuff. Futures down by 0.4% on the S&P. Coming up tomorrow, the former Labour Department economist Betsy Stevenson, Russ Kostrick of BlackRock, Aaron Kennett of Clear Harbor Asset Management, Bruce Kasman of JP Morgan from New York City. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.